Good morning. It is Thursday, February 9th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. And here are the three things you need to know to start your day. Disney CEO Bob Iger announcing plans to cut 7,000 jobs and slash $5.5 billion in costs. This move is part of a major reorganization that will separate the company into three divisions: entertainment, ESPN, and parks. Iger also promised to make money from streaming in the coming quarters after the direct-to-consumer business lost $1.05 billion on an operating basis in the quarter. The changes come amid a proxy fight with activist investor Nelson Peltz and his firm Trian Management. Bob Iger's comments that dividends would return was widely interpreted as a win for Peltz. PepsiCo sales rose by nearly 11% last quarter. That's more than analysts estimated. Profit also topped forecasts as higher snack and drink prices offset rising costs. The company boosted its annual dividend and announced plans to repurchase $1 billion worth of shares. The maker of Mountain Dew and Gatorade has battled higher commodity and labor costs, as well as a strong dollar eating into international revenue. Pepsi says it expects inflationary pressures to persist, though it sees resilient consumer demand. And retail trading app Robinhood's cash flow continued to improve last quarter as its adjusted EBITDA beat estimates, even as revenue missed forecasts and crypto trading revenue fell in particular. Monthly active users declined for the sixth straight quarter to 11.4 million, in another sign that the retail trading craze continues to fade. During the company's peak in early 2021, monthly active users surpassed 21 million. The company's board also approved a plan to purchase up to 55 million shares bought by former FTX CEO Sam Bankman-Fried from last year. And now let's get over to Brad at the Wi-Fi Interactive for a look at the market action.
Thanks, Julie. Inside of 30 minutes until the start of trade here on this Thursday, this Friday's Eve. Taking a look at the Dow futures. As of right now, we are in the green. We're up by about 0.7%. Nasdaq futures also higher, and that's leading the charge here on the day, at least among the U.S. major averages. You're seeing that up by about 1.4% right now, 170 points in positive territory. S&P 500 futures, they're also higher by about 0.9%. It's been a big week for some Fed speak as well. Let's just take a quick look at where some of the yields are. You're taking a look at the 5, the 10, and the 30. All of those right now are down, but we'll continue to watch very closely to see exactly how that Fed speak continues to get priced into some of the market activity that we've been tracking over the course of this week as well. Saz?
All right, let's get back to our top story here. Disney CEO Bob Iger announcing sweeping changes for the entertainment giant in his first earnings call since his return to the helm in November. 7,000 job cuts, billions in cost savings, and a new company structure delivering a dose of magic to investors. And this cost savings number, I really think surprised a lot of folks on the street. Some of the numbers that I heard coming into this earnings report, the street was looking for maybe cost cuts of around $2 billion, if not more. This is now more than double what many people expected here. So your first thought is a lot of costs, of course, coming out of this business. Profits will start to improve. And I can't say I am surprised to see Disney's ticker, our top ticker on the Yahoo Finance platform, after a cost-cutting initiative like this.
It's so interesting, Nelson Peltz getting everything he wished for without actually having to have a board seat.
That's life. You don't have to do any work. You just use your name and you boost the stock price.
Look, at the end of the day, when we were listening into this call, this was a kind of threading of the needle as we had described it yesterday evening after the call wrapped. But even going forward from here and some of the initiatives that they laid out, two things really jumped out at me that I wanted to point to. One of them is the efforts that they're going to have going forward. And within that kind of restructuring of the business, ESPN, the brand and program of ESPN, Bob Iger saying it's very healthy and they're not considering a spinoff of ESPN. That was one big answer that a lot of investors were looking for. What was the inclination of Bob Iger to really do with ESPN? Jimmy Pitaro is still going to be leading that division as it gets kind of its own pillar within the business. But then additionally, you heard about what the licensing strategy would be like going forward from here too, and that's on the table in some content licensing and being able to monetize that. You think about what ESPN or kind of Disney had done in the past. You used to see 30 for 30 on Netflix. You don't have that there anymore. Netflix has got Untold. It's not as good as 30 for 30.
It is
in my
pretty good,
opinion,
though.
but it's pretty good. But anyway, that's what we could see come back into the fray now with Iger too.
One of the other interesting takes on ESPN came from Laura Martin over at Needham. She said maybe they won't sell the whole business. Maybe they'll sell a 10 to 15% stake in ESPN, which was sort of a different twist on what I had seen. As we look at this new Disney in these three different divisions, the remaking of the entertainment division is also something that a lot of analysts, including Martin, are focusing on here. She commented that it was Iger's most important operational change to give content creators P&L responsibility again. What does that mean? It means if you're producing content for that entertainment division, you are responsible for the budget, for making sure it makes money. When you're faced with a more than $1 billion loss in that business, it makes sense. And this is really fascinating to me, the switch in focus from subscriber gains at any cost to making that business make money.
Right, and when you stand up a reporting structure like this, to your point, Julie, it drives better accountability. Now, if these creative folks are not getting the job done, they don't come out with the right content, they're going to get axed. And that will drive more cost cutting at this business and then ultimately fuel what an activist investor like a Nelson Peltz wanted. It's not just to bring back a dividend, it's cost cutting, drive a more efficient Disney, drive more creativity, improve profits, and finally get this really a business that is in many respects grown out of hands in some areas, get it under control and just drive better returns.
We'll see if it works. In the meantime, that direct-to-consumer business at Disney lost $1.05 billion on an operating business basis in its latest quarter, with Disney Plus subscriptions falling for the first time ever, down about 1%. CEO Bob Iger also announcing it will no longer provide long-term subscriber guidance. The company won't. Let's dive into the streaming strategy with Yahoo Finance's Ali Canal, who, of course, has been tracking this story very, very closely. So what are your takeaways here?
Well, even though those numbers seem pretty dire, that $1.1 billion loss is actually a significant improvement compared to what we saw in the fourth quarter. In the fourth quarter, Disney reported DTC losses of $1.5 billion. They guided that those losses would improve to $1.3 billion in Q1. So we saw this beat expectations in this quarter. So investors really championing that narrow loss under the leadership of Bob Iger, who did not hold back on those cost-cutting plans, as we were all just discussing. And on that Disney Plus subscriber front, that dip in subscribers was largely expected due to the loss of the Indian Premier Ticket League tournament. So that is something that was expected. And as you were saying, Julie, it really underscores this shift from subscribers to profitability. Even Bob Iger admitted that on the pricing front, there were some things that they probably got wrong. Too much spending on marketing, too much spending on promotion. So Disney is going to reduce that type of spending along with its spending in general entertainment, going to be focusing more on what Disney makes Disney Disney, which is really that family-friendly content. He also seemed more open to price hikes in the future, saying that the focus will be on quality subscribers, those subscribers that will remain on the Disney Plus platform, even if they price fees a little bit higher on those subscriptions.
Real quickly, I want to stay on this pricing, but we are getting a statement from Tryon and Nelson Peltz telling us via email, we are pleased that Disney is listening, Brad. So, of course, Peltz very engaged here.
Well, it comes back to the profitability that Disney had talked about on the call. By the end of 2024 here, pricing going to be a key strategy and part of that too. And that's from everything from the parks, the resorts experience, which they talked about, and trying to get that pricing right. But then additionally, on the ever-important streaming relationship that they have with consumers.
Right. Bob Iger seems really committed to have Disney Plus achieve profitability by the end of fiscal 2024. And on the park side of the business, that is something that Iger said that they probably priced too aggressively, that they were alienating a lot of consumers. He said the word accessibility. He said that over the past few years, Disney hasn't been an accessible park for a lot of consumers. And we've heard that across the board. A lot of Disney fans frustrated at those higher prices. And Bob Iger last month, he did make some of those adjustments, providing a little more freebies to those premium park members. So we should continue to see some changes on that front as well.
All right, Yahoo Finance's own Ali Canal helping us break down all things ticker symbol DIS, Disney. Thanks so much. Appreciate it. You guys, diving more into Disney's earnings as part of our three things this morning. Disney parks were a major bright spot in the results, with our next guest saying that the union single-handedly drove the upside for the company. Daiwa Capital Markets America Senior Research Analyst, Jonathan Keys. Jonathan, thanks so much for taking the time here with us this morning. All right, parks, resorts, how did that play out in the quarter from your perspective? What type of runway does Disney need to create going forward?
Sure. First, thank you for having me. In regards to your question, parks and resorts, they've been the saving grace. It's ironic. They were what sunk the company during the COVID era, during the lockdown. Now they're what's lifting the company. So this is the beauty of having a diversified business is with economic times. Yeah, the strengths will offset the weaknesses, and that's what's happening right now with the cyclical business. Supposedly there's a recession going on. That's not happening at the parks. Parks are going straight. I think what's important is that they're talking about reservations are still quite strong, kind of through the roof. They're not looking to change things too much. Even the cruise ships, the cruise ship that just was launched last month, that's now profitable. So the cuts that you've been talking about in your discussion so far is going to be mainly in the media segment. So right now there's 2 segments. There's parks, the physical stuff, the resorts, hotels, cruise ships, and then the media and the DTC. That's where the cuts are going to be. Most of it, of that $5.5 billion that Iger talked about, will be in content, but the others, the staffing, the 7,000 will be in back office or in marketing in those areas. So media is facing the macro challenges of lower advertising in this supposed recession, as well as subscriber cuts in terms of cord cutting. And parks will continue to lift up, I see, in the foreseeable future. This December quarter is seasonally strong. It was just seasonally stronger than everyone expected, and that lifted up the results.
So, Jonathan, just to linger on parks for a second, it sounds like you don't think they need to cut pricing. I mean, is it too expensive to go to Disney World, Disneyland, the other parks? Is that a problem for them?
Yes and no. So what this does is it makes them exposed mainly to the upper to high-end consumer segment, which are feeling less pain from inflation, from the economic pressures. But Disney, part of Walt Disney's mandate has always been accessibility, has been always appealed to the masses. So what Iger talked about and what you kind of touched on is having basic prices expand the number of days. So Iger actually talked about it in the call. 15 days was what was provided in terms of off-peak bottom rock pricing, theme park pricing. Previously, now he's expanded 50 days. They're all basically going to be off-peak when it's less crowded, but at least there's more choices if you're coming in on a tight budget.
Jonathan, did Bob Iger do enough to keep Nelson Peltz off this board?
I think it's interesting how that has directed. First, I'll take a step back. Some of the feedback I've gotten from my clients that I've even read about is that Bob Iger stepping in was going to throw in the kitchen sink, just declare a bad quarter and lower expectations and go up from there. I think Nelson Peltz came in and changed the dynamic. Bob Iger had to change everything, show progress from day one. So rather than the kitchen sink procedure, which is what a lot of new CEOs take when they come on board, he just started with a stellar quarter in terms of results. And previous quarter, they missed on both bottom and top line, and just start talking about cost cuts in terms of bringing back the dividends. So that was one of the things that Peltz have talked about is shareholder return, capital allocation is bringing back the dividend. That is acquiescing to Peltz. Now, Peltz wants more. He wants to actually control some of the strategic direction, even the creative direction of media. They're saying he's not qualified. So I don't think that fight is going to take place. The proxies have been sent out. Shareholder meeting will be next month. At this point, that fight is still going to take place.
So Jonathan, real quick on this fight. So you don't see Peltz selling his stake given the pop in the stock price. You see this going right up to the annual meeting in April.
I think so, yes, because he's still saying it's worth a lot more than currently. He has less power, less leverage now because the stock price has gone up since Iger has come on board.
Jonathan, just kind of similar to that, though, Iger had said that Nelson Peltz doesn't understand our business. Does this change, this restructuring, make it easier or harder for every investor to understand Disney's business?
I think this restructuring makes it a lot easier, especially for the activists. So one of the things that previous activists had pushed for was the selling of ESPN. And that's been also echoed by previous investors voicing criticism. ESPN is a central part of the strategy for Disney streaming, as well as just the cable business. And Iger made it clear he's not selling it. And I disagree with the comment that one of my peers, said selling a percentage of that. They like to have complete control. We haven't even talked about the option to buy the remaining part of Hulu that they don't control from Comcast. But they separated it in order to let people know how well ESPN is doing. Other than that, the whole business is the same. They're just giving more P&L responsibility and distribution responsibility to the creative content within the media group. But the only thing different from the previous structure that is still currently in place is that they just broke out the ESPN unit.
Yeah, did they set ESPN up in order for somebody to be able to come in and take a stake of ESPN?
I really don't think so. They like to have complete control over the creative aspects of it. They like to dictate how things are put together. They are under pressure to do something about the stake that they don't control in Hulu. And previous management commentary from Disney has been they're interested in buying out Comcast. It's when you have two big players controlling something, it's hard to say which direction to go if they disagree. So that's why a lot of these joint ownership of properties, while it's less risk financially, it's more risk strategically and creatively.
All right, we'll leave it there. Top analysis here for us on a very important day. Jonathan Keys, Daiwa Capital Markets America's Senior Research Analyst. Good to see you. We'll talk to you soon.
Thank you for having me.
All right, let's move on to thing number 2 here. PepsiCo posted a beat on the top and bottom lines in its latest quarter and reported a nearly 11% rise in sales as higher snack and drink prices offset rising costs. Joining us now is PepsiCo Vice Chairman and CFO Hugh Johnston. Hugh, always great to get some time with you here. So I'm listening to your earnings call moments ago, and I'm like, wow, PepsiCo really crushed it again. Good soda sales, new push into zero sugar, lots of new innovation in Frito-Lay. And then towards the end of the call, Hugh, you mentioned you may see a recession later this year. I mean, how severe do you see this getting? Do you have to cut prices? Just walk us through some of that thinking.
Yeah, let me try to characterize that. Good to be with you guys again, as always. What I was really laying out is we put together a set of planning assumptions around that because we always try to plan multiple scenarios. We pick one and then we say, okay, look, if it does better than what we planned, great. We know how to handle that. It's always harder to catch up if you plan a better case scenario and then you're dealt with something worse than that. So, no, we have no intention of cutting prices. That's certainly not part of the year. Frankly, we're coming out of 2022, which was just an outstanding year. I mean, 14% revenue growth, strong EPS. Obviously, the company is just firing on all cylinders, competing very effectively. We've got good momentum coming into the year, but we're also well aware of the fact that, in a high interest rate environment, it could start to drag on consumer spending at some point. If it does, we've planned a lot of productivity in the year so that we can manage that and still deliver the numbers and deliver a good return to shareholders. And if it turns out to be better than that, well, that's terrific. Then we'll be able to both invest back in the business and deliver even more to shareholders. So everyone will win in that scenario.
Solid guidance, Hugh. 6% organic revenue growth expectations for this year, 8% core EPS growth expectations. Within that is a mild recession your base case.
Correct.
And how sustainable, given that guidance, how sustainable are the margins in the Frito-Lay business? I think you got some commentary on that in the call.
Well, I think they're incredibly sustainable. I mean, what you see happening in Frito-Lay right now is we're investing to drive accelerated growth. So, look, Frito-Lay for the year grew revenue 17%. I mean, this is a gigantic consumer products business growing revenue 17%, and it grew operating profit 11%. So I'd much rather be in that scenario than much lower growth and margin accretion. That said, I think Frito with 27 margins, we'll be in and around that space, I think, for a long, long time. We don't give division-specific guidance, but I think Frito's margins in the high 20s is a reasonable place for us to be. But in a business with 27 margins, you always want to grow it as fast as you can because you're making so much money on every sales dollar.
Hugh, it's Julie here. I want to know a little bit more about pricing and about your thoughts on the Fed word of the day, disinflation, right? The price increases that you guys have been seeing over the past couple of years, are they starting to slow at all? Your input costs, that is. And can you give me a little bit of color on the different areas and what you're seeing?
Yeah, input costs will still be up for us during the course of the year, more in the first half and less in the second half.
But at the same rate that they have been?
In the first half, it'll be similar. In the second half, it'll be lower. So as a reminder on that, Julie, we forward buy about 9 months on most of our commodities. So the commodities that we're selling right now, we locked the price in on that sometime last June. That's very similar to most of the players in the consumer product space. So as prices started to, or as inflation started to diminish, still positive inflation, but diminished over the course of the last months, you'll see that start to play in our financials, particularly over the latter half of the year, less so in the former half of the year. And frankly, our pricing will be roughly in line with what our inflation numbers are. For the year, we had gross margins basically level. I'd expect our gross margins this year, which is obviously, it's pricing less commodity inflation, they'll probably be pretty level to maybe slightly up versus 2022.
Hey, Hugh, you were projecting that the North American divisions would stay resilient and the international markets perform well in 2023. Just wondering if you can kind of give us that on a quantitative basis.
Well, we don't get into division-specific guidance because A, it's too volatile anyway, and B, candidly, we wind up getting into a level of granularity that we'd rather not talk about. Here's what I would say is, we think that the categories that we operate in will continue to do well. Our plan is to gain share in those categories. So whatever the categories do, we expect to do a little bit better than that. And I think that generally means good, strong growth, not just for North America, but for international as well.
And Hugh, it sounded like a new push in the zero sugar soda game. Now you reformulated the Pepsi Zero Sugar. What changes in the formula and how big is that overall portfolio now?
Yeah, so our Pepsi Zero Sugar formula has been around for a while in the U.S., and it's a bit of a different formula than the international one. It had a bit more caffeine in it and some other ingredients. We've decided to harmonize more on the one that we've used internationally. As Ramon noted on the call, it's a softer taste. I find it to be a more refreshing and delicious product. So I think by virtue of bringing that in, we'll actually gain access to more consumers. You'll see it prominently featured in the Super Bowl. We'll have Ben Stiller as well as Steve Martin created some terrific Super Bowl commercials for us. And we're excited about it. I think you're going to get a lot of trial on that product. And once people try it, they tend to stick with it because we think it's the best tasting product out there.
Noted. As I get ready to shop at Target or Walmart this weekend. And then, on the topic of Super Bowl, Hugh, how much will you spend this year versus last year? Just curious on what your investments look like in the big game this year.
Yeah, it won't be dramatically different. Obviously, we don't have the halftime show. We had it for 10 years. We felt it was time to move on. But you'll see 4 big commercials on 4 big brands featuring some huge celebrities. We've got Elton John. We've got Missy Elliott. As I mentioned, Steve Martin, Ben Stiller, Jack Harlow. And in addition to that, we've got the guys from Breaking Bad in what I think is going to be an outstanding Poppables ad.
Well, I hope that you got to at least be on the sidelines while those were being shot, Hugh, because that sounds like a lot of fun, those various ads. Great to catch up with you. Hope you enjoyed the game and snack on some Doritos while you were watching it this weekend. PepsiCo Vice Chairman and CFO Hugh Johnston, great to catch up with you.
Thanks. Great to be with you guys.
And now a little more on thing number 3. Robinhood posting a revenue miss and a wider than expected net loss in the latest quarter as it deals with declining crypto trading revenues and slowing interest in retail trading overall. The company's board also approved a plan to purchase up to 55 million shares that had been bought by former FTX CEO Sam Bankman-Fried last year. We've got you covered on all things Robinhood. We're going to dig into these numbers a little bit further later in the hour. Coming up, A firm shuts down its crypto business and slashes 19% of its workforce. That story and all your other movers is coming up next.
Robinhood shares are on the move higher despite another tough quarter for crypto and stock trading sales as the platform sees monthly active users decline for a sixth straight quarter. Well, on the positive note here, good to see the co-founders pulling back on $500 million in compensation. That's very generous of them during these tough times. Really love to see it.
Yeah, how nice. I guess on
and
the
after a
bright
challenging it's post-IPO life for this company. Good to see them. I don't know, just giving back to the shareholder base a little bit here.
Well, yeah, two of the down spots, monthly active users, they were down sequentially to 11.4 million, down by about 0.8 million. Ultimately, they're 800,000. And then the assets under custody, that also decreased. However, two bright spots. Net deposits were actually higher. I believe in this most recent quarter, actually, I know in this most recent quarter, it was $4.8 billion. In the prior quarter, that was about $2.7 billion. So clearly, there were some inflows at least. But then additionally, you think about the average revenues per users, that did increase to about $66, that from $63 in the third quarter.
You know, we always look at these numbers, real quick. It's like $500 million in share-based compensation. It's just a number on a page, but if you just really think about it for a second, it's a $500 million. It's just, wow, it's just some of these numbers.
You mean that the people were making
for these compensation
collectively
plans,
that
like,
much?
Holy
yes.
cow.
Yeah.
Holy cow.
Yeah, holy cow is right. So the other thing we have to talk about when it comes to Robinhood is that they're trying to buy back some of these SBF bought shares, right? So we're talking about 55 million shares that entities controlled by Sam Bankman-Fried had purchased. Now, the wrinkle here, of course, is that the entities, at least some of them, are now in bankruptcy. So will they even be able to buy these shares back? So that's sort of it seems like that's something that investors maybe are happy about as well, that they're trying to buy back these shares. But I don't know how it's going to happen, the mechanism, all of that stuff.
It's going to be a spending environment too for Robinhood. They launched Sherwood Media, the formation of their media company, and that entity. It's going to be more focusing or building on Robinhood snacks that they had before, news on markets, yada, yada, yada. So all that considered, spending on content. You've also got some of the Robinhood retirement accounts that they're kind of unveiling beyond just the beta or beyond just the initial introduction that they had put out to the market as well there. Plus, on the crypto front, that Wallethood, or not Wallethood, Robinhood. Hey, Wallethood, Hood Wallet, whatever, self-custody app here. So you're going to continue to look to see how the market responds to that.
And then turning to some bigger picture retail sales data as we get the opening bell this morning, maybe it's appropriate to talk about this. JP Morgan and the team over there out with some interesting data on fund flows this year, and particularly fund flows among the older cohort of retail investors. They say these are folks who tend to invest via funds like ETFs. And their data found, JP Morgan's data found, that those people put $81 billion into bond funds and $44 billion into equity funds this year. Now, the preponderance into bond funds makes sense. Everybody that we've been talking about, almost to a person, has said they like fixed income this year. But they said the shift into these ETFs generally really represents a big change from last year when there was $340 billion in outflows from bond funds and they didn't buy any equity funds. In other words, what we've been seeing in the market has been backed up by retail investors, especially older retail investors buying into ETFs, which is really interesting.
OGs of retail trading.
Yeah, I mean that there's still that money is coming back in. Anyway, interesting here. Money's coming back in today, it looks like. Brad, what are you seeing on the Interactive?
Yeah, spitting facts over there on the desk. Dow Jones Industrial Average right now, that's higher by about 0.8% at the gate. We got green on the screen. It's actually a hat trick, the trifecta, the triple-double, whatever you want to call it up for the U.S. major averages. The Dow Jones up, the Nasdaq Composite higher by about 1.25%. S&P 500 also up. That's up by about 0.9% here. Let's take a brief look at the sector activity. 11 S&P 500 sectors. We've got them all pulled up for you here intraday. We're higher across the board, being led by technology right now. That's up by about 1.5%. Since that's all green, let's take a gander at some of those streaming stocks as well that we've been tracking and see exactly where some of the other major players are moving here. I'm just going to put this on an equal view so you could see what's taking place here. This after Disney reported earnings last night and discussing some of what their pricing strategy may look like. It seems the rest of the streaming street is perhaps taking clues as to what this may mean for themselves here. You've got Roku up by about 1.7%. Warner Brothers Discovery, of course, home of HBO Max, you're seeing that higher by about 1.6%. And then much of the rest of the streaming names also moving higher in concert. You've got Netflix up by about 0.9% as well as Apple and Comcast. So continue to watch those names as we move on throughout the rest of today's trading session.
Real quick, can you humor me and pull up Google? I mean, this is just, Julie's been flagging the move in Google all week. This has just been an awful week, in large part based on all the enthusiasm off of Microsoft's moves in artificial intelligence. Google had an event this week, and the stock has been absolutely obliterated.
It has been. Yes, this is that obliteration that you're talking about right there, and it moved lower yesterday. And really on much of the conversation around AI and generative AI specifically. And we've continued to discuss with some of our guests that it's not necessarily a zero-sum game. Perhaps there are different iterations of what this may look like within different Google Cloud suites, within the Microsoft corporate and collaboration suites as well. But for Google right now, a lot of the street kind of fading what their AI play has been thus far with Bard.
Yeah, I mean, but there's so many assumptions baked into that drop, right? The idea that Microsoft with this ChatGPT enhanced Bing is going to somehow wipe Googling away, like overnight. I mean, listen, the magnitude of the drop maybe doesn't imply that, but it implies a big loss. And we're going to talk much more, by the way, about Bing, the history of it, what a ChatGPT enhanced Bing looks like later on with our Dan Halley. But it has been sort of the story of the week thus far. Microsoft, as you point out, Brad, has decidedly gone in a different direction up over the past week or so. Speaking of decided directions, let's talk about Affirm. That's another mover we're watching. The share's down 11% on the back of its latest quarterly results, missing analyst estimates on the top and bottom line, and the financial technology company also cutting 19% of its workforce. Listen, we knew that the sort of buy now, pay later model was showing some cracks. We'd seen that is certainly in some of the firm's competitors as well. Max Levchin, the CEO, remember, who also founded PayPal, saying that the company, by becoming leaner, will emerge as a stronger company, better prepared to capitalize on our opportunities.
This is the bleak, I think just the overall mood right now at a firm is internally bleak, as it should be. This is a tough riff, as you would call it, almost 20% of the workforce. But overall, this is the bleakest I've heard Max and the team on the earnings call last night. You know, they've been always very upbeat on the prospects for their business, and a lot of parts of the business are still growing. They're still calling out potential to reach adjusted operating profits for their current, for their fiscal year. But still, this is a big cut. You have to wonder how it hurts morale and how it hurts growth for this business moving forward. It also looks like they made a mistake on pricing. Looks like they tried to push through higher prices and customers balked.
Yeah, it looks like about 485 people are going to be impacted as a result of this. That based on some of the numbers that they had put out at the midpoint of last year as well, and them calling this one of the single most difficult cuts that they've had to make at the company. You'd also had some of the analyst reactions here saying that the macro backdrop is uncertain, but they still believe some of their initiatives will drive higher acceleration for the first half of fiscal year 2024 for the company. All right, let's also talk about here Wynn Resorts moving right along this morning. Wynn Resorts is out with a mixed picture on its quarterly results. However, the company announcing this morning its plan for a private offering of $600 million of Wynn Resorts Finance senior notes due 2031. A brighter picture on the earnings front for MGM Resorts, though, International, beating revenue estimates and reporting a narrower than expected earnings loss here. I just want to kind of swing back to Wynn Resorts for a hot second here. One thing that I've been doing a quick control command F on in these earnings reports and the earnings calls as well is anything on Macau, anything on China. And you heard that in the Wynn call last night from Craig Billings, the CEO there, saying that the recent actions in Macau and mainland authorities reopening the market give them some good confidence that the difficulties are behind them here. So to what extent that begins to show up in future earnings reports, that'll be something to keep a close eye on here as we move forward with regard to this broader kind of reopening to the travel and tourism landscape here too.
Yeah, that's a good tip, Brad. Just in reading earnings calls in general, I know we're focused here on Wynn, but read some of these transcripts and just pull out keywords. Some of the keywords I use to just mine this data. Right now, it's China, it is disinflation, and of course, it's economy. And you'd be surprised some of the themes that you can quickly put together just by doing that.
I mean, it's hard to overstate what a dramatic change these businesses had over the past few years, because they had been so weighted to China. I mean, both of these companies, whether you're talking about Wynn or MGM, both of them get Vegas revenue. They get other regional casinos in the U.S. In the case of MGM, it's a bunch of them. In the case of Wynn, it's mostly Boston. And then you have China, mostly, or I guess all in Macau, right? And the China revenue had basically gone away over the past few years, both because of regulation, then obviously because of COVID. So now they're essentially trying to rebuild that business. But the shift in revenue, I mean, I can't imagine working in an operation. You know, you must get seasick from the sort of back and forth that happens from that. And that's still the case, that the China revenue is much smaller as a percentage of the whole than it was before. Yeah,
they gave actually some stats to that effect as well, to your point, Julie, saying the Chinese New Year holiday period, in that period, the casino, the mass table drop actually reached 95% of 2019 Chinese New Year levels, strong play across the spectrum, and premium. And within this premium experience, people go into casinos, you know you're going to spend money at the end of the day. It's like when you're going to Disney World, you know you're going to spend money.
You just surrender. You say, this is what's going to happen.
Just take my money. Just take the cash here. And that's a specific part of the experience economy that is perhaps a divergence between where you're looking to find value in that experience economy and find a deal versus where you just know you're going to spend and who's best to benefit from that. Perhaps it could be some of the casinos if the golden age of travel still holds true and has some solid tailwinds to it. And then additionally, it could be Disney at the end of the day as well.
In China, they haven't had the bounce back that we've had here, right? They're much earlier in that cycle. They've just opened up. People, I'm sure, are raring to go.
It's your move, by the way, Brad, in our digital poker game. No, we're just kidding.
You
go already? I've been waiting for like 5 days for you to go. Come on.
Look, I win my hands on the river.
Not chess.
Guys, coming up on the other side of the short break, Toyota is shifting into high gear. We're going to break down those numbers next. Toyota hit the gas in the third quarter with the operating profit climbing, a surprising 22%. Vehicle sales rising despite supply chain headwinds as well. Yahoo Finance's Pras Subramanian joins us now to break it down. Pras, what jumped out to you?
Yeah, Brady, some good news for Toyota. Shares climbing in the pre-market here. Revenue, $75 billion-ish around there, beating estimates. Also, you're noting profit, $5.5 billion, beating estimates too, in dollars that is. Margin dipped slightly, talking about some higher selling costs, admin costs, but they maintain their outlook. They're seeing about 10.4 million units sold for the fiscal year and revenue to increase 15% for that year. One little soft spot is electrics. They sold 12,000 EVs globally for the quarter. That's up from 5,000 a year ago.
I know. Is that number right?
That is correct globally. If you include hybrids, it's about 30% of overall sales. So a lot of hybrids there, the Priuses and things like that. But a long way to go with battery electrics, and that's sort of why you see the Akio Toyota stepping down, right, and being replaced by the Lexus head.
Yeah, that is awful. Well, staying on electric, on a day where we have Disney earnings out, PepsiCo, the top ticker on our site, Pras, is Tesla. The stock really continues to be on fire.
Yeah, Saz, we were here a few weeks ago, and the stock was hovering on $100, and now we're almost double that, right? And that main catalyst being that earnings call that we were all on. We did that show on. Elon talking about demand outstripping supply. Shares sort of surging since then. The Fed talking about the disinflation talk, also giving tech shares a lift. Tesla in tandem as well. And here we go. Look, almost 100%, $200 a share. Remember, Mark Newton was on a few weeks ago and said, "Hey, it's bad, but it's oversold."
Wow, that is tremendous. Pras Subramanian, thanks so much. Appreciate it. All right, if CEOs sound dreary on earnings call this reporting season, it's probably because they have a lot of concerns on their minds. The number one concern for CEOs around the world is an economic downturn and recession, according to a new survey from the Conference Board. Inflation is coming in second there, as you can see right there on our chart of the day. Lots of concerns among CEOs, but top of mind remains concerns about a recession. Like we just heard commentary from PepsiCo CFO Hugh Johnson telling us that their base case this year is, in fact, a mild recession. Coming up, we're lifting the hood on the latest market action in today's Morning Brief newsletter. We'll discuss next.
With the stock market only open for 6.5 hours a day, it's not surprising that trading outside normal hours can have outsized importance. As Jared Blickery writes in today's morning brief, for the bulls to win out, they need to assert dominance, not only during normal trading hours, but also after. There's been a major push, especially within the last 10 years, not just for exchanges to recognize some of the before the bell and after the bell movements that are taking place in orders that are continuing to flow in, especially considering the amount of earnings reports that investors like, well, not like ourselves, but we ourselves as well as investors are parsing through both before the bell and after the bell and trying to set trades around that activity and pivotal information that companies unveil.
Yeah, clearly I would think something has to change, just given I think this increased volatility in this environment with all the liquidity sloshing around the markets. And look at a firm. I mean, you see these double-digit declines on the slightest bit of news here. I hear what Jared's saying. I think it's a well-written newsletter.
Yeah, so basically what he's saying is that we have to see more buying after normal trading hours. What's interesting is that folks who are trading those hours aren't the big institutional traders, right? It's smaller traders because there's not enough liquidity at that time to have larger institutions. But nonetheless, it is interesting that those periods of time lead the market. He also points out all of the net gains in the market have been made on Tuesdays, Thursdays, and Fridays. I don't know, there's all this interesting sort of market tidbits that Jared is pulling out to say really the narrative needs to change before stocks can gain in a more sustainable fashion.
All right, let's bring in a pro here who might have a take on this. We'll stick with this conversation on the Morning Brief newsletter and the market indicators that are keeping tech bearish. Let's welcome in Brent Schutte, Northwestern Mutual Wealth Management Company Chief Investment Officer. Brent, good to see you here this morning. Heard us talking about the Morning Brief newsletter. Just your take on the overall environment now. We're still trying to digest some, I would say, hawkish rhetoric from the Fed this week and some disappointing earnings, more layoff news. Where do you stand?
Yeah, I think I come at it differently than Jared does, but come up with the same conclusion. I mean, to me, you've seen those inflation fears, kind of tying into your prior segment with CEOs' worries. You saw those inflation fears peak last October. And I don't think it's so coincidental that the market actually bottomed on October 12th, which was the day before you actually had the September CPI report that kind of showed inflation beginning to melt. And so I think that's been the tone that's been better in the market. You've seen disinflation, a term that Chair Powell used over and over, happen. But I don't think we're out of the woods yet. I think you're shifting to recession fears. I think right now the soft landing is still, I think, something that people think could play out. But I think you'll eventually get a mild recession, which I think will cause some market consternation. And only once do we figure out that it's going to be short, uneven, and mild, then I think you can actually have that better forward path that Jared's looking for, where the market does move more sustainably up.
What does it tell you?
So I guess a little bit different than Jared, but same type of outlook.
Yeah, certainly. And Brent, what does it tell you that CFOs like those that we just heard from Hugh Johnston over at PepsiCo are forecasting for a mild recession right now? They're practically baking that into their expectations.
Well, I think that tells me that it's largely baked into the market. And so if you think about it, I mean, this is the most well-telegraphed recession. The Fed's intention has been to get us to the point of a recession, but perhaps not tip us into that for the last year or so. And so I can't remember a more well-telegraphed recession. It doesn't mean that it's all discounted, but certainly a lot of the actions that would that would happen normally during a recession that was a little bit more uncertain in its arrival, I think you've seen a lot of those things already occur. And so I think it's going to be an uneven recession. I mean, you mentioned Pepsi, and perhaps it'll be more recessionary there, but you mentioned casinos on the other side of it. I think those parts of the market right now, the economy, are still where you're seeing demand. It already feels like a recession, I imagine, in the housing industry.
All of this said, you said in your note to us, there are opportunities in the market here, particularly what you see as cheaper parts of the market. Where are those cheaper parts of the market, especially since we've seen a rally this year?
Yeah, this is where I think people come onto your show likely and say, if the market were just cheaper, I'd actually be more optimistic. And I think there are cheap parts of the market. So yes, the S&P 500 overall does trade at around 18.5 times earnings. But if you look at the S&P 600, which is small caps, it trades at about 14 times earnings that have already been marked down. You think about mid caps, same type of valuation, and even value stocks, kind of away from that Nasdaq talk that you had in the opening. Those parts of the market are cheap. And dare I say, international stocks. And so I think there are parts of the market that are different than what investors are used to actually buying because they didn't work as well over the prior 5, 6, 7 years. I think those parts of the market have already discounted a lot of potential bad news, and they trade at valuations that are cheap. And that's where I think you want to be positioned in 2023.
Hey, Brent, we've heard from Delta CEO Ed Bastian in the past that airlines, as well as much as the travel industry, is in a counter-cyclical recovery. How much longer, perhaps, can that counter-cyclical recovery still hold a trend or still hold some wind in its own sails, given the fact that there are so many other parts of the economy and the markets and the companies that are being evaluated separately there that are in a very different scenario?
Yeah, and this is where we had a rolling opening. I mean, if you look historically in my 28 years of doing this, I've never seen an economy shut down completely, then shift all to the good side of the equation, then shift back to the services side of the equation. Look, I think you're going to actually have a mild recession. I think it's going to pull down quite a bit. You've seen liquidity dry up. Eventually, the consumer will pull back as companies begin to lay off more people. But I think it's going to be incredibly short. And so I imagine the travel industry is going to have a boom as people continue to go back out and kind of spend money that direction. But with the economy overall slowing and probably layoffs on the way, I do think you are somewhere nearer to a recession than further away. And so I think that would be a period of time where that will slow, but I don't think it'll be deep, just given the reality that I don't think the Fed has to keep rates where people are suggesting they're going to have to keep rates. I do believe they will have the option to cut if they need to, because I think inflation falls with any recession.
Brent, good to catch up with you. Brent Schutte, Northwestern Mutual Wealth Management Company Chief Investment Officer. Thanks. Coming up, we're going to do a deeper dive into some of the top trending tickers on the Yahoo Finance platform. Stay with us. Let's take a little walk through the trending ticker page from yahoofinance.com. And there we find, among other movers, Credit Suisse, which is down 12% today. If you look at its year-to-date performance, it shows you a 3% gain with the drop in today's session and that 69% decline over the last year. The company today reported that it's going to see another loss this year after its worst annual performance since the financial crisis and its fifth straight quarterly loss of about $1.5 billion. Customers withdrawing $100 billion last quarter. The company saw a 96% plunge in equity trading revenue, an 84% drop in fixed income trading revenue, wealth management revenue down 17%. You get the idea. Things are tough over there at Credit Suisse, even as it prepares the spinoff of its CS First Boston unit and did a transaction to that effect today. So those shares trading down sharply. But elsewhere in some of the movers that we're looking at today, we have AbbVie switching back over to its daily performance. The shares up 3.5%. AbbVie is a really interesting one because its blockbuster anti-inflammatory drug Humira is a $20 billion annual drug for it. And it's lost patent protection for the first time. Last quarter was the last full quarter in which it had exclusivity here in the United States. And in that quarter, it narrowly beat analysts' estimates. But analysts are now having a hard time picturing what does AbbVie look like without this huge drug. The company forecasting adjusted earnings per share this year of $10.70 to $11.10. Some analysts were below that, but again, they're having some trouble gaming this out. All of that said, the shares are reacting well to the numbers today. And then wanted to get to Kellogg as well. Those shares are not moving as much, but they are trending because folks are looking at these numbers. The company has now said it decided to retain its plant-based business as it prepares to split up the company. Earnings beat estimates, sales rising 12% ahead of estimates as well. So those are some of the trending tickers here. Just to give you a little walkthrough, as I said, Tesla's also on that list. Disney, as you might imagine, is on that list. Pepsi, whose CFO we talked to earlier. And Alphabet still trending. Investors and retail traders still very interested in Alphabet as it falls another 3% today. Coming up, why our next guest says the market action has been justified by several silver linings this year. What are they? We'll tell you next. Plus, the future of Bing. Dan Howley's going to break down all the details later on in the hour.
Welcome back to Yahoo Finance. I'm Brian Sozzi alongside Julie Hyman and Brad Smith. Markets taking their lead from earnings beats out of consumer names PepsiCo and Hilton this morning. Right now we're seeing all three major indices in the green. Dow up close to 230 points. And here's what's on tap this hour. No fun. Mattel shares crash as the toy industry falls on hard times. We have the analysis. And the cost of ChatGPT, we have one number you need to know if you are a Microsoft investor. And under siege, Salesforce gets attacked by yet another activist investor. Brad, let's get over to you.
All right, thanks so much, Brian. Taking a look at the major averages here as we're 31 minutes into the start of trade on this Thursday. The Dow Jones Industrial Average up by about 0.7%. Nasdaq Composite up a full percent. S&P 500 up 0.7% right now. 4146 is where we find the S&P 500. We'll come back to that in a moment, but taking a look at some of the Nasdaq 100 activity that we're seeing here on the screen today, you'd be hard-pressed to find some of the companies that are in the red right now, but who's bringing up the caboose today? It's Alphabet, Google, that's down by 3.2% on the Nasdaq 100. However, leading the charge, you've got ticker symbol AZN there. It's higher by about 5.9%. AstraZeneca leading the charge there, and a whole wave of other green names here. But Lucid also one of the biggest laggards in the Nasdaq 100. In terms of the S&P 500 sector performance here today, technology is still holding on to that bright spot and leading the charge here, but energy is actually in the rear. That's down by about 0.4% on the day. Communication services, that's also lower right now. That's down by about 0.25% after starting the day positive. We had all 11 S&P 500 names and sectors, starting off the day in positive territory. A little bit of slippage in communication services and energy right now. But as I was mentioning a moment ago, that S&P 500 number sitting at 4146 here on the day, and here's the context. A hawkish tone traveling among Fed officials as a handful of them point to the strength in the job market as evidence that inflation pressures remain persistent, calling for the likelihood of the Fed having to continue to raise interest rates and keep them elevated for longer. So what does this hawkishness point to for the markets? We've got Anastasia Omarosa, who is the iCapital Chief Investment Strategist, here to discuss with us. Anastasia, always a pleasure to speak with you. I continue to point back to that 4146 number on the S&P 500 because I know that you've been tracking 4,200 as one of your key levels that you've been keeping tabs on as well, and saying that worries you if we do reach that. Why is that?
Well, it does worry me because we had such a stellar run so far year to date. And as Julie said, I do think it's been justified. But at 4,200, you're kind of running into just fundamental math problem, which is the S&P is already trading at 18.5 times forward estimates. And those forward estimates are $225 for this year's earnings. So it's really difficult to see how we're going to break above the 4,200 given those two sets of numbers. If we could construct a scenario where there's upside to those numbers, that would be one thing, but I have a hard time doing that because the multiple 18.5 times already feels pretty stretched given where the environment is. And then 225, that number has come down significantly. I think there's scope for maybe some more downside revisions, but most importantly, near term, there's probably not scope for upside revisions. So because of that, we do see the near term upside for the market that's capped. Now, I will say, Brad, that as you move forward into the year, and if we do in fact manage to really convincingly have the soft landing and the Fed eventually eases, that's what gives the upside to those two numbers. But again, that's not a near-term scenario. That's a longer-term, 6 months out scenario.
And that's an if scenario, even if you look a little bit further out there. So on the flip side of that, do you think we see sort of a drift lower, or do you think that there are actual negative catalysts out there rather than just sort of an absence of good news? Is there actual bad news that you're bracing yourself for?
Yeah, I think the markets would be savvy, I guess, to prepare themselves for some bad news. What's driven the market so far is this, kind of three factors that were positive, which is inflation coming down, which is growth declining sort of in line with consensus expectations, but also kind of stabilizing a little bit because consumer sentiment popped and manufacturing PMIs have popped as well. And then there's this expectation that the Fed is reaching the end of its hiking cycle. So those are the three things that drove the upside. But there's some risk factors to whether those good news continue. And one of the risk factors is inflation. And I don't necessarily mean the next week's CPI print. That might still be supportive of this upside narrative. But what happens around the turn of the year? And we might just find out that this disinflation that's been playing out in the goods sector, that actually might be transitory. And the services inflation, which is coming down, but it's still so sticky with wages rising at 4.6%, that may mean that we're not going to see this perpetual fall to 2%. And if you kind of project out the month-over-month change in services CPI inflation, we're not actually on pace to 2%. We're on pace to more like 4%. So that worries me, Julie. And I think that's a scenario that the markets are not currently pricing in, along with what the Fed may need to do in order to respond to that sticky inflation.
Staying on worries, we've been talking all week long about FOMO, a lot of fear of missing out creeping into these markets. We're seeing with certainly AI-related stocks, but also Tesla. I mean, Tesla has more than doubled off the lows. How concerned are you about this market action?
Look, on the one hand, it makes sense because I think there was a lot of tax loss selling that happened at year end, and in things that we hit the most last year, which is the likes of Tesla and ARK and some of the other high growth tech stocks. And so as we breathe a sign of relief on the Fed and inflation, it makes sense that the valuations of those things expand. But if you just look at the technical indicators and how much these stocks have rallied and how overbought in certain cases some of those positions have become, I do worry about the potential for consolidation there. So, Brian, one of my strategies to think about right now is, maybe you don't want to get out of the market. I don't think you want to jump at right this second. But if you do hold some of those positions, why not sell some covered call options on those positions? Because chances are in a stock like Tesla and, some other high growth stocks, you have a high volatility still, and they've rallied a lot. And if we think there's limited room for them to continue to rise near term, you might want to sell a call option and collect that premium. So that would be my strategy here, to kind of position for some consolidation and give back in these stocks.
Anastasia, Saz mentioning AI sort of reminded me of our obsession with it this week, and everybody's obsession with it seemingly this week. Anything with AI in the name going crazy. Obviously, a lot of attention on Microsoft and Alphabet. How are you thinking about this topic? Is it something that you think is going to be a long-term good investing opportunity?
Long term, absolutely, Julie. And artificial intelligence is something that I've been tracking for a while. And I will say this is one of the biggest commercial trends that we have in the world today because it affects every single industry vertical that can implement artificial intelligence. It is a huge productivity boost potentially for each one of those industries. It can power new products that we've not had before. So that amounts to a very big, large commercial opportunity. What worries me about artificial intelligence at this very moment is, there's these hype curves and graphs. And I think if you looked at it today, artificial intelligence is probably approaching the peak of that graph. And when you see stocks that have AI in them trade up, by 100, 170% in a short period of time, that worries me. Having said that, if you look past that, I absolutely think it's a huge opportunity. And we thought about what are some of the ways to position for artificial intelligence. Of course, the big tech companies are going to be one of the winners in AI because they have the data, they've amassed it, they can use it to train their natural language processing algorithms and machine learning algorithms. And if you're a smaller company, why reinvent the wheel? You are going to go to some of those big tech companies for those AI and machine learning tools. So long term, absolutely, big tech is a beneficiary. The second one is the semiconductor space, because you can do AI without more powerful compute. And for that, you need the graphic processing units or the AI ASIC specific chips. And that's why some of the semiconductors have done really, really well that are tied to that space. But the third component of that, Julie, if you think about, who doesn't know what semiconductors and who doesn't own big tech, and you probably already have them in the portfolio, but if you're looking for something new, it's the AI-powered businesses that maybe have not yet been discovered. And what I'll tell you there's maybe some that are happening in the public markets now, but there's 58 times more, actually 64 times more artificial intelligence private market companies relative to public market companies. So I think if you're truly looking for standout opportunities in AI, I would actually look to some of the private companies that most of them are venture capital backed.
Anastasia, while we have you, you know I love to always get your crypto insights here. It was something that stuck out to me from the Robinhood call last night, without talking specific names here, something that they mentioned, a very frigid crypto winter here. And sure, we've had a little bit of a bounce in some of the main crypto prices to start off 2023, but with this frigid crypto winter, as Vlad Tenev was describing it, how much longer do you think we could still be within that realm?
Well, I think there's some good things that are happening in crypto. First of all, if you look at the performance of Bitcoin, for example, it is the exact opposite of what we saw late last year. And Bitcoin, if you look at the cross asset class performance, is actually one of the top performers this year, up 34% or something like that. So I think that tells you that there's certain parts of the crypto ecosystem are here to stay. And Bitcoin is likely one of those because it's not been financially over-engineered. And once the Fed potentially does pivot, once inflation does come back, real rates potentially start to decline, you can see investor appetite come back to Bitcoin. The second thing I would say that's, I think, good about the crypto environment, and hopefully last year and the beginning of this year, is the flush out of all things bad in crypto that were overly engineered, they're overly speculative, and what's left are companies that are building true solutions, that are making trading more efficient, that are making lending more efficient, that are making payment settlement more efficient. So I would say our focus would be on, very few top, most reputable cryptocurrencies. And then along with that, the focus would be on identifying the companies that are solving real world challenges with crypto and blockchain.
Good insight as always. Anastasia Amorosa, iCapital Chief Investment Strategist. Have a good weekend. We'll talk to you soon. Nothing is free in this world, and that includes Microsoft's integration of ChatGPT functionality into Bing's search engine. Morgan Stanley analyst Keith Weiss estimates near-term integration costs of $600 million to $1 billion annually for Microsoft. Coming up, Shell is facing a lawsuit over its climate strategy. Julie will discuss that, plus have more top headlines you need to know next.
Disney cutting 7,000 jobs in an effort to slash $5.5 billion worth of costs. The news comes as the company beat earnings expectations on both the top and bottom lines for its first quarter. Here's what you need to know. Disney reporting its quarterly earnings results, beating analyst expectations on both the top and bottom line. The House of Mouse posting earnings of 99 cents per share and $23.5 billion in revenue for the first quarter of 2023. This is the first earnings report since Bob Iger made his surprise return as Disney CEO back in November. Iger sharing the company's plans to cut costs, which include reducing the workforce by 7,000 jobs. He told shareholders he does not make this decision lightly and that the changes will put Disney in a better position to weather future disruption. The Disney chief executive reassuring investors the new strategic organization will result in a more cost-effective, coordinated, and streamlined approach to running the business. Disney also reported an expected dip in subscribers on its streaming platform Disney+, but an improving loss overall in its direct-to-consumer division. Another bright spot for Disney was its parks and experience business, which remains strong, growing a whopping 21% as Disney fans continue to flock to its theme parks in droves.
Let's check the current, a look at some of the other headlines moving businesses and markets right now. And we start with an outage at Twitter that left some users unable to post new tweets, follow others, or send direct messages. The issues, which began surfacing yesterday afternoon, now appear to be resolved, but come as Twitter is gearing up for the Super Bowl. The sports event expected to be a huge draw for users and advertisers. It comes as new CEO and owner Elon Musk tries to eke revenue from the microblogging site following massive cost-cutting measures and layoffs. 11 members of the board of oil giant Shell are being personally sued over allegedly failing to manage climate risks. In what's been labeled a first-of-its-kind lawsuit, a group called Client Earth accuses the company's directors of failing to implement a strategy that moves it away from fossil fuels and in line with the Paris Agreement. Shell's rejected the claim, saying all decisions were made in the best interest of the company. And household service cleaner brand Fabuloso recalling almost 5 million bottles over potential bacterial contamination. The Colgate-Palmolive brand saying the cleaners did not have enough of an antibacterial preservative added. It's offering reimbursements for affected customers. The cleaner is commonly sold at major retailers. Kind of ironic here, Saz, that a cleaner would not have enough antibacterial stuff in it to keep it safe.
Yeah, if that's what you're marketing, Julie, definitely need that. That's why I just use bar soap. All right, turning now to the state of the jobs industry. Disney announcing it will cut 7,000 jobs as it restructures, adding to a long list of companies shedding staff early in the year. Tech company Zoom also adding to the pain with its own cuts announced yesterday. For more on the state of the jobs market, let's bring in Daniel Zhao, lead economist at Glassdoor. Daniel, good to see you here today. How bad do you think the labor market is right now? We just came off a very strong jobs report, but this layoff news, in many respects, is starting to get pretty jarring.
Well, we do have a tale of two labor markets going on right now. We do see very, very strong quantitative data when we look at the jobs report that came out last week. And then we also, just in general, when we see layoffs from the JOLTS data remain very low. But of course, we see these headlines of all these major companies laying off workers. And so I do lean more towards the quantitative data. I think anecdotes, we always get a lot of attention on layoffs, but we don't necessarily see those companies that are hiring, an extra 100 or an extra 1,000 workers. So overall, I'd say the labor market is still strong, but clearly there are some pockets of weakness going on.
How does that contribute to wage growth on a continual basis here? We've already seen wage growth remain somewhat elevated here. And so for employees that now find themselves laid off, can they expect to be willing to, or not be willing to, but be able to find an even higher paying job when they finally do get back into the workforce?
It's a good question because traditionally going to get a new job is how you get a raise because you're resetting your pay to the market rate, which doesn't really happen when you're sitting at a job, right? But of course, if you're laid off, then people tend to prioritize different things. It's more about job security. It's more about finding that job quickly rather than trying to optimize for the largest raise possible. I do think that people can still find a well-paying job, if not one that offers a raise, but it's certainly a lot harder than it was maybe a year ago or even 2 years ago.
Daniel, you guys have done some research as well as to how sort of people are perceiving how their industries are going, right? In terms of growth, in terms of hiring. Who's sort of the best and worst on that list?
So we have seen some of these traditionally, quote unquote, white collar industries like finance, tech, insurance, real estate. These industries have seen a pretty significant uptick in the share of employees who have a negative business outlook for their employers. And in fact, in many of these industries, that negative outlook is actually worse than where it was at the start of COVID. On the other hand, you have industries like energy, aerospace, defense, these industries are more positive and their employees are still feeling relatively okay. And I think to some extent, what we're seeing here is a bit of a revenge of the in-person economy. So just, with Disney's announcement, we saw that their in-person parks segment was doing particularly well. And I think that's where a lot of consumer spending is going. And at the same time, you're seeing kind of a pullback in some of these pandemic era darlings, as well as layoffs in some of those tech companies or those other companies that might have overhired in anticipation of these pandemic era trends staying for the long term.
I was looking at some of the kind of findings, but also report highlights from KKR that were out this morning. And they talked about this labor market, this tighter labor market, continue to pressure central banks to hold nominal interest rates higher in the near term. So what do you think that signals as well for this longer term cycle of the relationship between employment and interest rates?
Well, I do think that we shouldn't read too much into just the latest jobs number. Obviously, we got a jobs report that was much hotter than expected, but there are question marks around whether that was more of a seasonal quirk or whether that's really the start of more sustained acceleration. I do think that it is something we need to think about. Like, we do need to be concerned that maybe a re-acceleration of the economy means that the Federal Reserve is more aggressive about restricting monetary policy, and it just makes a soft landing, the path to a soft landing, muddier, right? Like it's not as clear that we are getting that gradual slowing in the labor market combined with that disinflation. Of course, we're going to get the updated inflation data soon, and hopefully that will show more of that disinflation. Ultimately, I do think that the labor market is doing its part, getting us to a soft landing. It's more about the inflation side. It's more about how central banks are responding to that.
Do you have any projection about how artificial intelligence might impact the employment situation and where that artificial intelligence, the automation might lead to some, of course, companies saying, hey, productivity will be higher if we just bring this in, as we had seen at some companies already announcing those swift moves?
I think it's probably too soon to really estimate the impact of, say, ChatGPT on employment in the short run or the medium run. But I do think that it is important to recognize that artificial intelligence is similar to previous trends around automation and technology, and those do definitely have an impact on employment in the long run. That being said, I think that a lot of people might have a bit of doom and gloom about how automation will take away jobs. But at the same time, this is in many cases about making people more productive, making people more efficient. And if you think back to a few decades ago, I think the analog here is really the advent of computers in the workplace, the advent of word processing software. And I don't think people really want to go back to a world where they're sending physical memos anymore. I think ChatGPT and these AI tools are kind of similar to that revolution where, there might be some clerical jobs or the clerical type jobs that go away if we're using that same analogy. But at the same time, by making people more productive, that means that companies can be more productive. It means that salaries can actually increase more for those people that are utilizing this technology. So I do look at ChatGPT and these AI tools as potentially revolutionary in the workplace, but it is very difficult to predict how it's going to play out in the employment space in the short term.
Daniel, forget going back to the days of clerical memos. I don't even want to go back to the days of scanning documents or faxing them for that matter. Let's not go back that far. Great to have you here with us today. Glassdoor lead economist Daniel Zhao joining us this morning. Thanks so much.
Thanks.
Coming up, the AI battle escalates. What this means for the future of Bing. Dan Halley's got the breakdown on Bing next.
Search engine second fiddle Bing is mounting a comeback. Microsoft's push to innovate search with AI is now threatening maybe to usurp Google's decade-long dominance with its conversational search model. Yahoo Finance's tech editor Dan Howley has the latest. We don't Bing it, we Google it.
Yeah, so that's the big problem, right? Googling is synonymous with search. You Google something. You Goog something, it's pulled up on the Googs, right? That's something that, is out there.
But
is it out there?
Yeah. I mean, look, it's out there in, the circles I hang out in, which are degenerates. But so let's just start off with what Bing is and Bing's history, right? Because it's kind of muddled at this point. So Bing actually kicked off, believe it or not, in 2009. It was the replacement for Microsoft's Live Search. And you see here, it originally was MSN Search. That was back with, MSNBC when Microsoft was part of that. Then we had Microsoft Live Search, just Live Search, Bing, 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 Microsoft Bing, and now we have Bing with a regular B. And so at the time when Bing was announced, it was actually pretty innovative. It had a related search panel, something that Google has now. It would pull up frequently searched for items. So if you went to look for a hotel, it would pull up the hotel's phone number in the search, something that we see now in Google. It also did things like it would preview articles when you moused over them. So it was a big deal. But at that point, Google was already, just entrenched. It's like a tick. You can't get it out. 91% market share at that point globally. And by the way, it was on the new crop of phones that was popping up, run by Google, Android. So what is Bing doing now? So what they have now is still a incredibly small market share, 92.9% for Google, 3% for Bing. By the way, that's the second best search engine out there. Wow. Yahoo exists somewhere along that continuum down the line. But we also have the idea that, so Google runs all of this. Google makes the vast majority of its wealth off of ads from search. So what does that mean for Microsoft as far as making money? Well, according to CFO Amy Hood, if Microsoft is able to claw back just 1% of market share, that's worth $2 billion in revenue annually. So they're under no kind of idea that they're going to pull back huge amounts of market share. They're saying, look, if we can go 1%, 2%, we're going to make bank on this, and it'll be worth our investment in the long run. What's more, Microsoft has been growing their search and news advertising revenue. Ex-TAC, it's 24% two-year compound annual growth rate. And the industry itself is at a 3-year compound annual growth rate of 18%. So Microsoft's beating out the overall industry. So I think what you look at when you see something like this with Bing, with this AI capability, is that they're fully reinventing their search engine. And as a result, what consumers will expect from search engines, right? And one of the examples that I have, I published a piece yesterday is, look, I have a 2007 Ford Mustang, right? Very cool when I bought it. Still very cool, by the way. The only people that have ever complimented me on it, old men. So,
I did too, so what?
I appreciate it. But so if I like big TVs, right? I want a 65-inch TV. So I looked up. I have a LG C1, very specific type of TV. Awesome. If you want one, go buy it. And this older Mustang. So I was like, okay, when I was going to buy this TV, I was like, well, is it going to fit in my Mustang? So I figured, okay, this is a few years ago. Let me look up to see if this AI can tell me this without me having to go through links and what's the dimensions of the Mustang's trunk? What are the dimensions of this LG? What happens if I pull out the seats? I entered in, can an LG C1 fit in the trunk of a 2007 Ford Mustang? And I'm not kidding. It pulled up exactly the answer, the dimensions of my trunk, the dimensions of the TV. And then it said, if you're buying a 48-inch, it might fit, but you might have to remove the trunk cover as well as some seats. That's not recommended. They said you can try putting it in the back seat and buckling it up. Make sure that you don't damage the screen. If it's anything more than 48 inches, it's not happening. And that's the kind of search that this is going to enable. So you're not going to have to go through all these different links. Here's an issue, though, with that, which affects us as journalists and other content creators as well, is you're getting all of those answers. Those answers come from individual websites. You're not going to those individual websites now, right? So it's going to hurt the revenue for content creators, for journalism. Microsoft says, look, we're linking to those sites. Fair enough. But if I have my answer right there, then why am I going to go to those sites? So, I think that's really kind of where one of the issues lies for Bing. But it is an incredible technology.
Yeah, when you were out in Microsoft's headquarters, that vibe, what was the vibe there on Bing and in artificial intelligence? Do you get a sense that there are true believers that they can really claw that 1% market share away from Google, or is this just a lot of hype?
Well, I think when I walked in, I think a lot of people were like, okay, ChatGPT, really interesting, but the people don't really use Bing. I use Microsoft's Edge browser on my PC at home. Chrome is just, it's basically like carrying around like a sack of molasses with you when you're on the internet. It slows everything down. I think with Edge, it's a much better form of Chrome. Bing, though, you don't, like we were saying, we don't Bing things. Once people started using this, though, they got really, really interested in it because of how impressive it is. And from what I've seen from Google's Bard so far, it doesn't offer the same kind of conversational chat, at least what we've seen from Bard as of yet. Bing is doing something that's completely different and really, truly amazing. Here's the issue. I was talking to Futurum analyst Dan Newman, and basically he said, we've seen incredibly disruptive technologies from ARM and AMD, and Intel still sits at 75% plus of the server market. So just because there's a disruptive, impressive technology doesn't mean they're going to pull it away. Here's two other issues for Microsoft and Bing. One is Android. It's the most used operating system in the world as far as mobile goes, and I think generally what comes installed on the vast majority of those Android phones? Chrome. Chrome runs Google. Also, if you have an iPhone, the default search is Google. So Google is everywhere, and it's still like that tick that you can't pull out.
Well put, Dan.
Get some tweezers. I guess like olive oil helps. I don't know.
Hopefully, I won't take the Lyme. I was going to say something about Lyme disease, but that analogy only goes so far. Thank you so much, Dan. I appreciate it. Well, the proxy fight between Disney and activist investor Trian Fund Management appears to be over. Trian had made the case earlier this year for replacing the media giant's board director, Michael Froman, in favor of instituting the hedge fund's Nelson Peltz on the board. Peltz had criticized Disney's weak corporate governance over the years that has eroded shareholder value, calling for several changes from the media conglomerate. However, now Mr. Peltz says he would pull back. You got a statement from him, Saz.
Got a statement from here from Trian Team to Yahoo Finance. Says, quote, the proxy fight is over. This is a win for all shareholders. And this really goes back to, I think, what we were talking about in our morning meeting here, Julie. Well, he looks like he made a pretty sizable gain here. Unclear exactly what price, but look, you had Bob Iger come here and I think surprise everyone with the amount of cost that he said he was going to take out of the business, $5.5 billion. The stock price is higher. He's also now restructuring the businesses. I don't think he would have did this without Peltz pushing him to do so. And this outline of what Iger's doing in terms of segmenting the key businesses is what Peltz really pushed for at Procter & Gamble. Procter & Gamble did that. The stock price went up, and it's continued to be a top performer here. So look, Peltz got what he wanted ultimately.
Yeah, you're watching shares here on the day actually moving off of some of their highs, and much of that had come on the back of the earnings call, not necessarily the report itself, as when the report dropped, it was up by about 2%. It's really what was announced on the call, what was very much signaled towards addressing the concerns that Peltz had raised, and that's when the stock moved higher, eventually was higher by about 8% in after-hours trading. But then now, even here, right now, you're seeing the shares reverse course, perhaps because that fight might be over.
Right, and now you saw that reversal, and I'm glad you spotted that, Brad, because it's worth mentioning. Maybe you see Peltz now sell his stake, right. And then obviously you're adding more shares to the market. That is putting pressure on there. But then, too, you also have to wonder, well, now that Disney announced this, does it get a little complacent without Nelson Peltz trying to get on the board?
Yeah, that was my thought as well, in addition to the concern about him potentially selling his stake. Okay, they've announced all of this stuff, which is great, but now the pressure is off, right? Are there going to be more changes that maybe investors think need to be happening? So still, I think it's not done just because he announced the restructuring and the cost cutting. This is just really the beginning. So now it becomes, I'm going to use one of those market cliches, a show me story, right? Sure. What is going to happen next for Disney?
If I can also add, it also seems like this was the exact cover fire that Bob Iger needed in his first quarter back as CEO to make some of these drastic changes too, even if they were already being talked about. And we don't know to what extent the Disney executive team was already pondering some of these massive restructuring changes, some of the job cuts as well, the focus on profitability. But we do know that in the changing of the guards from Chapek to Iger, that there was going to be some type of massive change. And for Bob Iger to be able to go on the call and make these type of announcements, I don't know if that happens without an activist campaign like a Peltz being kicked off as well.
No, that's right on, Brad. Definitely on point. All right, coming up, it's tough times for the toy industry as seen in a rough quarter from Mattel. We're back with more analysis next.
Mattel shares are getting rocked, down by almost 11% after a disappointing quarter and outlook. And that comes hot on the heels of major layoff news at Hasbro. Saz has toys on his brain today for his take.
Yeah, definitely I do. And I think if you want to tie up what we're hearing from the toy industry, it is essentially this. Economy slowing. A lot of these companies have pushed through higher prices. Consumers saying, well, we just not going to buy these toys. We're going to wait till they're about 70% off. But let's hit the high-level news here. Mattel earnings last night, stock under pressure, as Julie just mentioned. Sales down 22%. That is not the normal rates of growth we've been seeing from Mattel over the past 2 years. So I think has a lot of investors spooked a little bit and has surprised them. Inventories up 15%, large part because those sales really fell off the map. Gross profit margins down 620 basis points year over year. Interesting to hear on the earnings call last night, really two things from Mattel CEO Ynon Kreiz, frequent guest on our programming. He says our fourth quarter results were below expectations as the macroeconomic environment was more challenging than anticipated. And to that end, I think taking a more sober tone on the outlook for the toy industry this year, Ynon noting that he sees the toy industry flat to slightly up this year in terms of sales, which is would mark a deceleration from recent growth rates. But it's not just Mattel. A couple weeks ago, Hasbro just came out with just another stinker of a pre-earnings announcement. Said they are canning 15% of their workforce. Fourth quarter sales crashed 17% there for Hasbro. They will report their earnings on February 17th. I can't imagine they will have anything good to say given the pre-announcement like this. You know, I also caught up too with another friend of our show, James Zahn, the editor-in-chief over at Toy Book, who is just probably one of the most interesting, or probably the best person to reach out to in all things toys. Tell me a couple problems for Hasbro outside of its debacle of Wizards of the Coast and their various gaming efforts. One, they recently moved to no plastic packaging for certain toys. And what that is you have the differences right here. On the right, you see old school Hasbro packaging. People like to see their toys, what they look like when they're in the stores. On the left, you're now seeing the new packaging. Yes, you have the toy on the outside of the box, but you can't actually see the workings, the mechanisms of the toys. And James telling me that is leading to sales pressure for some of Hasbro's products. Also telling me that the Hasbro base price on the 6-inch action figure jumped from $19.99 to $22, then $24, and then in some cases $30. That is a that is some serious inflation on price-sensitive toys here, and parents are just not going to buy these things, and that's why you see inventory in the channel starting to really back up. My take is this, and maybe not a shocker, just given my really negative commentary here. There's no reason to go near these stocks. Yeah, that's not a buy or sell decision. That's just basic level analysis. You have sales falling off a cliff for toys. You have high inventory levels. You have retailers like a Walmart and Target not placing a lot of replenishment orders right now. And it is unlikely that the toy industry really gets back to growth maybe into the holiday season of this year.
I didn't recognize some of those toys. Did you recognize the guys that look kind of like He-Man, but I don't know, maybe that was He-Man?
Oh, the early ones, no, I didn't recognize too many of them. I recognized the ones towards the end, but that was it. And the toys are noticeably smaller too, even on screen.
Do you know this series? I'm not familiar.
Whatever. They don't make toys, I would argue, like they used to. I personally think the quality has gone down. I used to be a little bit of a toy geek.
Well, forget about the quality. I don't. Maybe this is some series that the kids are watching. That I recognize.
Yeah.
That's a dinosaur.
But who was the dude before? I don't know who he is.
I got a good example for you, real quick. So I bought my nephew a new, for Christmas, a pound puppy. Stuffed animal. I remember having them when I was a kid. I had 4 of them. I bought him 2. And you can tell like the eyes on the pound puppy, they didn't look right. They were cheaper quality. The stuffing felt a little different. It's just not the toy I remember from the 80s, and it was disappointing. And I don't know if he still has it. You know, they like playing with the boxes at that age, but still, I was disappointed. I wanted more from the pound puppy.
I'm very sorry.
Yeah, I was disappointed, actually. I'm getting sad now.
I feel like we've got a puppy eye situation coming on. Puppy eye situation coming up. Small businesses are voicing concerns over government programs. We're going to speak to one small business owner next.
Over the last 2 years, a record 10 million Americans applied to start new businesses. 10 million. And by the way, every time someone starts a small business is an act of hope. And Madam Vice President, I want to thank you for leading that effort to ensure that small businesses have access to capital and the historic laws we enacted that are going to just come into being.
You heard President Biden there at the State of the Union mentioning the growing number of small businesses around the country and the efforts on the federal government to get them more capital. But according to a survey from Goldman Sachs, 70% of small business owners give government programs a grade of C or below. Let's get into the survey now with Jessica Johnson-Cope, Goldman Sachs' 10,000 Small Businesses Voices National Leadership Council Chair. And of course, she is a small business owner herself. Jessica, thank you for being here. Why is the federal government getting such a bad grade on this?
Well, I think the Small Business Administration is well-intentioned, but many small business owners don't have the full breadth and depth of programs and services that the SBA offers, and as a result, aren't able to take advantage of those resources and programs that can help us to grow and sustain our businesses. So that's probably why the scores are so low for the government's take on small business.
Jessica, good to see you again. It's been a little bit here. What if President Biden is reelected? What could his administration do to make life easier for you and your business?
Well, I'm encouraged by the State of the Union address that the president has focused on bipartisanship and working together on either side of the aisle. Small business is not a partisan topic. It's something that requires support from both the Democrats and the Republicans. So we look forward to the administration to continue to focus on aspects that impact small businesses, such as access to capital, such as access to contracts with federal agencies. And regardless of who ends up in office, I think if we have those things, small businesses will grow and flourish here in the United States.
The administration being one thing, but then the access to capital via banks and financial institutions being another as well, in tandem with what small businesses need to weather what some large businesses, large enterprises, and publicly traded companies are trying to brace themselves for in a mild recession. How can small businesses better position themselves in the instance of a mild recession occurring within the next several months or even year?
Well, I'm encouraged by the survey data. You mentioned that Goldman Sachs recently released survey data from some of the alumni of the 10,000 Small Businesses program. And there's a level of optimism because many of our small business participants have realized how to do more with less coming out of the pandemic. So wherein the economic pressures are going to affect all businesses, both large and small, if we continue some of the practices that we put in place during the pandemic, I'm sure that we'll see that small businesses will come out okay during the current economic challenges. But access to capital will remain something that's important. And we'll be looking to the large commercial banks to put small businesses in context when they look at their underwriting standards, because we still need the money that's going to help our businesses to grow. But when you give a small business the monies to grow, that has a larger impact because small businesses employ more than 50% of private sector jobs. And that means that there'll be a positive impact in communities by putting people to work, by increasing payrolls, and by increasing the tax base in local communities and across the country.
And Jessica, part of what you're talking about is the reason why the federal government during the pandemic initiated that Paycheck Protection Program, right? That funneled a lot of capital into small businesses. But talk to me about the sort of transition from that, right? That was a time where there was certainly friction in that process as well. But kind of where are small businesses in the cycle coming out of that time when they were getting an infusion?
So small businesses have begun to stabilize and to look to the new normal. So how we ran businesses before COVID may not be the same way that we do it now. But many small business owners are optimistic because now that the world is open again, we see an increased consumerism, even though people might not be buying toys like you talked about in your previous segment. But we do see people are spending money again, and many consumers were able to increase their savings and increase their disposable income during the pandemic. And so small business owners are trying to leverage those opportunities, those selling opportunities to stabilize and to grow. Long term, it may mean that we have to be a little bit more conservative in how we hire. We have to take in mind the supply chain challenges that we faced over the last year and a half, 2 years, and maybe have picked up new suppliers for our products and services. But we still feel the pressure of increased interest rates. We see the pressure of inflation. And so we're managing through the businesses by being consistent, putting into practice some of the things that we did during the pandemic, and then tightening up our belt straps so that we can make it in the long term. The president also mentioned the increased number of new businesses that started during his administration. We're very excited about that, because that means that people are taking their destinies into their own hands. And with more new businesses, there are opportunities for small businesses to do business with one another and not just to depend on the large corporates. So it's a great time to reimagine what the future of small business and what the future of our nation's economy can look like as a result of the current economic pressures that we're feeling.
Jessica, thank you so much for the time here today. Goldman Sachs 10,000 Small Businesses Voices National Leadership Council Chair Jessica Johnson-Cope here on Yahoo Finance with us this morning. Thanks so much.
Thank you. Have a great day.
You too. Coming up, everyone, a buzzer beater of a trade deal will share Kevin Durant's next destination. That's on the other side of the break. Welcome back, everyone. It's time for Cup of Time. 3 stories, 1 minute each. We start with this. We got 2 for you today, actually. Dan Loeb's Third Point is reportedly taking a stake in Salesforce. This is according to the Wall Street Journal. This would be the 5th activist investor known to take a position in the software giant. It's been quite the year. Everyone lobbying their activist campaign into Salesforce, shares of CRM.
I've never seen this before, and I've covered activist investing for a very long time. I know I look young, but 5 activist investors to attack a company, a household name company like Salesforce is just mind-boggling. And I think at this stage in the game, I think Mark Benioff, the CEO of Salesforce, should take a page out of what Bob Iger did and come out blasting here. If he wants these folks to get off his back, he's going to have to come out aggressively, really aggressively, and cut billions of dollars of costs if they are in fact there, because this is now at the point where it's a dark cloud over the stock, and it is likely impacting how this company operates from day to day.
And he hasn't taken the opportunity thus far to do this, right?
Happened.
He has missed the opportunity to do so. The proxy period for this company opens on February 12th. That's when they can start filing what they want to have happen, including potential board seats. So that's going to be the period to watch.
Mark is open to good ideas. He wants to hear good things. He is a very collaborative person. I just think it would behoove him, just get this done, get these guys out of this stock, stop so we're not talking about this anymore and going back to talking about growth at Salesforce.
Speaking of which, what happened to our buzzer? There it is.
All right, a blockbuster NBA trade at the buzzer between Brooklyn and Phoenix. The Nets have agreed to trade Kevin Durant and TJ Warren to the Suns in exchange for 3 players plus 4 first-round draft picks and a 2028 pick swap. Now, leave it to me to immediately jump to just behind the scenes on this happening is Matt Ishbia. He is now the owner of the Phoenix Suns here, and of course he's the CEO of United Wholesale Mortgage. Has been on our programs many times. Coming out of the gate here, he is coming out of here blasting, very excited to get his hands on this team and bring his approach to running this business.
He needs a distraction because his stock has
been down.
As a person who lives down the street from Barclays Stadium, Barclays Center, I'm very upset because now I'm going to a stadium where there's just going to be a team where you've got a hope and a prayer for the future.
Well, Monday Night Raw is going to be there next Monday at Brooklyn. So
well, yeah. Well, it's going to be great in Arizona for the stretch of the next couple weeks here. You got the Super Bowl. You got a growing Suns organization. The fan base, no doubt, going to reward this. Look, Michael Bridges, I mean, great. He's coming to Brooklyn. And Villanova, hey, V's up. But my goodness, that's all we got.
Dismantling. Just dismantling.
Dismantled, yeah.
Coming up.
Good thing I'm a Sixers fan.
Coming up in the next hour, Rochelle Akuvo is going to speak with Macquarie's Chad Bynum on the back of those earnings reports from MGM and Wynn. Plus, Saz is going to be back for an interview with the CFO of Hilton. Keep it right here.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akuvo. Here's a look at what I'm watching this morning. The hawks are circling. A week of comments from Fed officials gives investors more than a little food for thought. Should we look past it or take them at their word? We'll put it all into perspective. And of course, results season driving market sentiment this morning. We take a look at the ride-hailing space ahead of numbers for Lyft and ask, has it positioned itself as more than an Uber backup on your smartphone? And Hilton shares jump as it beats the street with full-year results. We'll speak with the group's CFO and ask if the landscape is still hospitable. You don't want to miss that. But first, let's take a look at the major indices an hour and a half into this trading day. We see all three in positive territory there. We see the Dow there just slightly off its highs though, but still up more than 200 points on the day, up 0.2%. You see the S&P 500 there up 0.5% as well. And the tech-heavy Nasdaq there up about 0.6%, about 74 points. Let's also check in on the Treasury market as we try and see some signs ahead for how they see the potential for a recession coming along. You see there all three in slightly negative territory. The 5-year, the shortest term yield, they're down 0.33%. The 10-year down 1.33%. Similarly, the 30-year down 1.3% on the day. Well, here come the hawks. A week of Fed comments coming in shortly after surprisingly strong economic data, including, of course, that hot jobs report. The takeaway, the Fed is unlikely to relent in its aggressive fight against inflation. Now, let's take a look at some of those comments this week with, of course, Fed Jay Powell as the baseline. We saw most Fed speakers aligned with his comments, with John Williams calling rates of 5 to 5.25% appropriate for the year. Neil Kashkari, though, on the more hawkish side of comments this week, saying the January jobs report indicated the need for more hikes. Now, of course, all of this showing a Fed that's more willing to consider keeping rates higher for longer or even raising rates further. The move set to continue putting the squeeze on businesses that find it harder to borrow from banks. Well, let's take a look at where all these Fed comments leave markets. Joining us now is Cameron Dawson, Chief Investment Officer at New Edge Wealth. Good to see you, Cameron. So, I mean, as we look at what we saw from these Fed speakers in force, mostly hawkish, but then how do you square that with this ongoing market rally that we're seeing when you have these easing financial conditions saying more hikes are coming?
Yeah, it's really interesting because what we see is the bond market is starting to wake up to this very hawkish Fed speak. We saw the 2-year yield jump after that strong jobs report. And as we've had all this hawkish Fed speak, we've also seen real yields start to climb. But we haven't seen any wobble within equity markets, which just means that equities really aren't pricing in this policy path that bonds are starting to now. And so we think that now that equities have had this big rally, you've seen valuations expand tremendously just to start this year, which does leave them vulnerable if that equity market eventually starts to wake up to this Fed policy path, meaning that there could be renewed downward pressure on valuations.
So then, Cameron, if markets think they've priced risk in correctly or not, then what's really behind this rally then, and are you buying into it?
Well, we haven't seen any support from the earnings front on this rally, meaning that earnings estimates have been getting cut throughout this rally. All of the rally has been driven by valuation expansion, multiple expansion. So if we look at the S&P 500, we're already back up to about 18.7 times forward earnings, which is really rather expensive from a historical perspective. Now, there is historical precedent for valuations to rebound long before earnings do, long before the overall economy does. But the reason that happens is because usually liquidity is expanding, meaning that when earnings are really weak, the Fed's just throwing money at the market. And the thing is, we've seen this big valuation expansion, but liquidity really hasn't been expanding. And so we do think that without a true pivot by the Fed, if the equity market doesn't get what it wants with rate cuts, then those valuations are simply too high.
And so then, for people trying to make sense that obviously the rally that we've seen coming into the year then, what have you been rotating in and out of as you really try and seep through the tea leaves here to find out and go really beyond the noise that you're hearing out here?
Yeah, we've stuck to our quality bias. It has caused us to lag starting this year, meaning that we haven't chased the big rallies in lower quality, speculative, high beta types of names, and instead kept with names that have strong balance sheets, generate a lot of free cash flow. And in markets like this, we will lag. But what we think is that we're finding opportunities still where valuations do remain well contained in some of these quality names to be able to build positions bonds for the long run, and we'll continue to buy more of them if prices do weaken. So we're not in the camp that we really want to be chasing the rally in the most speculative parts of the market, simply because, again, we don't have that kind of liquidity support. So we're sticking with quality, even though it's meant that we've lagged to start the year.
And we know that markets have sort of jumped with every sort of bit of weekly or monthly data that's come out. And you're, of course, keeping an eye on the CPI data that's coming out on February 14th. What are the expectations there and how you think the markets might take that?
Sure. Well, we see potential for CPI to possibly come in hot next week. If we look at the two biggest sources of disinflation through the back half of 2022, it was gasoline prices and used car prices, which all fell pretty consistently through the back half of last year. But starting in January, we've seen gasoline prices climb 12%. We've seen used car prices up 2%, which just means that those big sources of disinflation might start to be moving in the other direction. So we think that this could be a hot CPI report and a reacceleration in that month over month inflation. We think month over month is more important than year over year because that has the skewed by base effects. So we're watching that very closely, because what that could essentially do is create more urgency by Fed policy members to talk really, really tough if that inflation starts to reaccelerate.
I'll certainly be looking for that, especially after all that disinflation talk we heard from Powell really setting off the markets at the moment. Cameron Dawson, great to have you on as always, Chief Investment Officer at New Edge Wealth. Thanks so much. Well, it's the comeback of the buyback. Meta Platforms and Chevron heralding what markets expect to be a big year in share repurchasing. Here with more is Yahoo Finance's Ines Ferre. Hey, Ines.
Hi, Rochelle. And year-to-date, buybacks announcements have topped $173 billion. That's according to data that was compiled by Reuters, with a record January where buybacks more than tripled from a year ago in January. So this really strong start to buybacks this year in 2023, but fewer companies announcing them compared to last year at this period, because you have 78 companies that have announced buybacks so far compared to 125 companies at this time last year. But the big ones have been, of course, the energy firms, the headliner being Chevron with its $75 billion buyback program that it announced this year. Meta announcing a $40 billion program. BP announced a program. UPS, MGM Resorts just announced theirs. Now, the criticism against buybacks has been that it artificially drives up the price of a stock. So just to go back, when a company buys back its shares, what it's doing is it's lifting up the price of the outstanding shares. And up until now, buybacks haven't been taxed. Now, this year, you have a 1% tax that was implemented. This was passed in the Inflation Reduction Act last year. It's implemented this year. And President Biden wants to quadruple that tax to a 4% tax on corporate buybacks. But Republicans are unlikely to see that go through. Now, companies like buybacks, though, because what it does is they are easier to suspend than dividends. It does lift up the share of prices where companies see the price of their shares that they feel are too low. Just to give you an example, last year, 2022, you had a record announcement of buybacks to the tune of $1.22 trillion. That's when the S&P 500 went into a bear market. Rochelle?
And we know, Ines, President Biden, of course, had some sharp words for oil companies engaged in buybacks. Let's take a listen.
If they had, in fact, invested in the production to keep gas prices down, instead, they used the record profits to buy back their own stock, rewarding their CEOs and shareholders. Corporations ought to do the right thing. That's why I propose we quadruple the tax on corporate stock buybacks and encourage long-term investments.
So we'll see some strong words there from the president on this and how he feels about buybacks, but we'll be keeping an eye on that as well. Anything that you take away from that in terms of, as you mentioned there, not likely to see much movement in the opposite direction from the Republican Party?
No, I mean, if that tax were to go through, then you could see companies going more towards dividends. But really, buybacks are preferred because dividends are a little bit harder to reduce, to suspend. And right now, it looks like Republicans would not let something like that go through. But this is what the Biden administration has criticized before. I mean, they put out a statement after Chevron announced its big buyback program, basically saying, you guys, what you should be doing with that money is you should be reinvesting it in producing more oil in order to bring down the price of oil. That's been the big criticism against buybacks. But for companies, this is a place for them to put their cash, and it is a way to, in a way, return cash to shareholders, Rochelle.
Well, free enterprise, right? Well, what can you do? Inez Ferre, thank you so much for getting us up to speed on that. All right, well, Hilton seeing a boost to its bottom line from higher post-pandemic travel demand. We will have an interview with the hotel chain's CFO, Kevin Jacobs. Yahoo Finance's Brian Sozzi. What can we expect?
Hey, Rochelle, what's going on? Well, three things I think I really would like to know from Kevin Jacobs. They're wrapping up that earnings call right now. First up, occupancy. Occupancy levels really improve year over year in most of the company's business segments or hotel chains. That's a very good thing. Revenue per available room, that is number two. What I'm curious to hear from the folks over at Hilton. They have pushed through price increases like a lot of folks in the lodging sector. Very interested to see how that has been received amongst consumers that appear to be pinching a lot of pennies. And then what is happening overseas? You know, I think one theme this earnings season, Rochelle, is that a lot of companies in Europe, in China, are continue to not do well because of more quicker economic slowdowns there compared to the U.S. Very curious to see how Hilton is doing over there as well.
Indeed, we'll be keeping an eye on all of that. Sozzi will be back with us later. Thanks so much. All right, coming up, the proxy fight between Disney and activist investor Trian Fund Management appears to be no more. Bob Iger's turnaround taking full shape, but are investors being too optimistic? We discuss next.
Disney cutting 7,000 jobs in an effort to slash $5.5 billion worth of costs. The news comes as the company beat earnings expectations on both the top and bottom lines for its first quarter. Here's what you need to know. Disney reporting its quarterly earnings results, beating analyst expectations on both the top and bottom line. The House of Mouse posting earnings of 99 cents per share and $23.5 billion in revenue for the first quarter of 2023. This is the first earnings report since Bob Iger made his surprise return as Disney CEO back in November. Iger sharing the company's plans to cut costs, which include reducing the workforce by 7,000 jobs. He told shareholders he does not make this decision lightly and that the changes will put Disney in a better position to weather future disruption. The Disney chief executive reassuring investors the new strategic organization will result in a more cost-effective, coordinated, and streamlined approach to running the business. Disney also reported an expected dip in subscribers on its streaming platform Disney+, but an improving loss overall in its direct-to-consumer division. Another bright spot for Disney was its parks and experience business, which remains strong, growing a whopping 21% as Disney fans continue to flock to its theme parks in droves.
Well, Disney's certainly optimistic on the outlooks for its theme parks, with CEO Bob Iger making known his bullish stance in yesterday's earnings call. But our next guest sees troubles in sight that may not be solved even with Iger's return as Disney's chief executive officer. Here to discuss is Jason Cochran, Frommer's editor-in-chief. Good to see you, Jason. So why do you think this changing... Well, good to see you. Why do you think this changing of the guard might not have the impact that some investors are perhaps banking on?
Well, it won't be immediate. That's the biggest reason. There's a long way to go, I think, for Disney to rebuild its reputation within the theme parks, because it's been, a good half a decade of, not so much investment, things getting a little dirtier, and the experience for customers getting a lot more difficult. And that's going to take some time to iron out, especially as Disney's method right now of making that 21% increase at the parks, as reported, has been basically to charge guests who are going more, to get more yield out of each person. And that's a strategy that they don't plan on reversing anytime soon.
And we know that Bob Iger did speak about this pricing for consumers and how off-putting it's been for people who want to come in, and perhaps that's why we didn't see parks grow perhaps as fast as he would have liked. But where does pricing rank for you in terms of really the issues affecting Disney's theme parks? You mentioned things like how happy customers are when they go there.
Well, it's pretty significant. I think if you ask most people what their biggest concern about is with the Disney park vacation that they want to give their families, pricing will be right up there. Rooms at some of the resorts at Walt Disney World cost almost $1,000 a night in some cases. And the way Disney's been able to get a lot more money into its coffers is to charge people a little bit more when they go into the parks. For example, I'll give you an example. Years back, 5-6 years ago, one could get a reservation for a ride, a time to ride for free. That now is a revenue stream for Disney. And it only started in the last 2 or 3 years. And that $20 or $30 extra you're going to pay every single day to guarantee that you're going to ride the rides you want is on top of parking, on top of ticketing, on top of souvenirs and food. That's a new increase. And it's one of the reasons that the parks have been making so much money that the rest of the company has been able to use to sort of pay down its debts or shoot shows for Disney Plus. Is the parks increasing the pressure on each customer has been getting higher and higher, and customers are starting to get frustrated.
And as you know, another way they're saving money on parks, though, is not having any major new attractions for a long time. I mean, we know that Bob Iger talked about the success they saw with Avatar, expanding beyond like the land they have in Animal Kingdom to do something at Disneyland. He didn't go into details that something would be Avatar related, though. But when you think of what it takes to build one of these parks and the time involved, what do people need to know about when some of that might pay off?
Disney is famous for being very slow about its construction projects, even more so lately. It's about to open a brand new roller coaster in the Magic Kingdom in Florida. I think the shovel went into the ground in 2017, perhaps. It's been a very long time for this thing to happen. Partly that's COVID. There were shutdowns in the middle, but it still does take Disney a long time to build a new attraction. And there are no major rides or attractions now that are in the pipeline. After this new roller coaster, Tron, opens in April, none of the American Disney parks have a major ride that's under construction now. It'll take a long time for those to come online when they finally start to be built. In the meantime, Comcast is about to open a brand new theme park in 2025 in Orlando to compete with Disney. And so that I think is going to be the biggest thing to watch in the next decade or so is, how far ahead does Comcast think it's going to get? And is it going to come neck and neck with Disney? Because increasingly it's building the infrastructure that people want to have. There's a nonstop appetite for new rides and new parks. But also, it's kind of less of a hassle for people to visit. And Disney's going to have to contend with both of those issues on the consumer front.
And we are expecting a lot from Universal. We've seen their growth as well. How do you think Disney, Universal, how do they stack up against some of these up and coming and other growing entrants into this theme park space, especially when you look at the overseas markets?
Yeah, the nice thing about Disney and Universal within the United States is they're just sort of competing against each other. There are other theme parks, but they're considered, maybe a day out with your family, much less of an event that the Disney and Universal experiences give people. So they don't have a lot of competition on that front. And very few Americans will fly to Paris or Tokyo or Hong Kong to those Disneylands. They just spend the money locally. So we do get a lot of international visits, especially to the Florida theme parks that Disney runs and Universal runs. But generally, the international parks don't give them as much competition. They're just sort of, it's an arms race. Again, it always has been for the last 25 years, an arms race against the two of them within the American market. But Universal is figuring out new ways to reach people across America without requiring them to travel to Orlando or to Anaheim. They're building a new sort of like a kids theme park in Texas. They've announced plans to build like an all year long Halloween scare house in Las Vegas. They're figuring out ways to reach smaller groups of people on a year-round basis with a lot less investment. And Disney is still sort of wedded to its massive resorts that cost so much to operate.
And that access is definitely important as, consumers consider how much they can actually spend in this sort of environment. It's certainly no small feat trying to pay for tickets to Disney. A big thank you there, Jason Cochran, from us editor-in-chief. Thank you for joining me this morning. All right, coming up, we book a ride and buckle up for a preview on Lyft's earnings coming out today. Are they making big moves in market share? That conversation next. Lyft is set to report quarterly results later today. Now, the ride-hailing giant has been making progress in improving its service as the ride-sharing market recovers. But are users loving the product, or is it largely used when Uber is unavailable? Yahoo Finance's Ali Garfinkel has more on where the company stands as we await those Q4 results. Hey, Ali.
Hi, Rochelle. So I think the question we've been implicitly asking over the last day or so here at Yahoo Finance has been, is Uber the backup to Lyft? And the conclusion we've come to has been,
But I think it's important to actually lay out the bull case for Lyft as well, because there absolutely is one, as it turns out. I want to direct you to a couple of numbers and use them to kind of walk you through it. So the first is, driver shortage was really hard on Lyft, but some numbers suggest that they're riding this rideshare recovery wave too, just as Uber is. For instance, some numbers to throw at you here. Active drivers at Lyft are up 40% year over year. New driver activations are up 70% year over year. And rider ETAs are 30% better year over year. So that looks pretty good. Simultaneously, they've also been diversifying geographically through an acquisition in bike share in particular. Last year, they acquired a company called PBSC Solutions, and PBSC Urban Solutions, forgive me. And what they do is they create bike share equipment, bike share tech, and not only does it give them a little bit more geography than they had previously, but it also kind of gives them an edge in bike share that can create a new market for them a little bit. Also, importantly, they have liquidity with net cash at $2.2 billion. Lyft recently laid off 13% of its staff in November, so they're cost cutting and they have money on the balance sheet. There are things to like about how this business is being run, analysts say, Rochelle.
It's certainly sometimes not front of mind for consumers when they're picking. And obviously, Uber has a lot more offerings than Lyft does. But looking forward to seeing what happens with Lyft and how they plan to grow the business from here. Ali Garfinkel, thanks so much. Well, to another kind of moving around, Super Bowl 52 is fast approaching, with football fans gearing up to tweet their team's big moments. Though confidence that Twitter will be up and running on game day is doubtful after the app crashed Wednesday, leaving users unable to post updates. Yahoo Finance's Dan Howley has the latest on the outage and what's going on at Twitter HQ. I know that when I tried to tweet or follow someone, it said, no, you can't follow any more people. I was horrified.
Yeah, Rochelle, I had the same exact problem. Horrified or thankful, one or the other, especially when it comes to Twitter. But yeah, I ran into the issue where I was trying to follow people and it said I had reached a limit. Then I tried to tweet something and it said I reached a limit as well. And this seems to be what everybody was experiencing on Twitter. It was down for about 90 minutes yesterday. The reason isn't exactly clear just yet, but you'll remember that Twitter laid off a huge chunk of its workforce and closed one of its servers out there in California. So there's been some talk about whether or not stability is an issue. Now, Elon Musk seemingly has talked about how stability is not a problem. According to him, they've proven that they can be stable in times of a lot of tweeting. This is just a random Wednesday, though. So, as you said, as the Super Bowl approaches and more people are tweeting, it raises the idea of will it be able to continue to support so many users. And it got through the World Cup, sure. That's much larger than the Super Bowl, although Eagles fans might not want you to think that. Let's go Giants. But, I think one of the big things to take from this is Elon Musk sent out a tweet, and essentially he basically told people at Twitter to stop working on features. He said, please pause for now on new feature development in favor of maximizing system stability and robustness, especially with the Super Bowl coming up. So this clearly means that they want to focus on stability, despite the fact that they had this downtime just days before the big game.
And you have to figure, especially as advertisers, getting a bit more stingy, getting a bit more tight with their finances. This is the last thing you want to hear, especially before something as big as the Super Bowl. And what do you think this does? Because people have a love-hate relationship with Twitter, but people were very, very anxious when they couldn't get on Twitter. So clearly there's the demand there. We'll have to see if that actually translates into people wanting to spend more money, though, on Twitter.
Yeah, I would say it's akin to an addiction with Twitter, where you're like, man, I hate that I do this, but I got to do it. It's like how I eat chocolate in the middle of the night. I hate that I do it, but I love doing it. And I think, that's what most people feel when it comes to Twitter. As far as advertisers go, that's, a bigger question. They've been having problems with advertisers since Elon Musk took over, and a number pulled back on their ad spend. So, we've had Twitter try to woo them back by offering them, discounts and things along those lines for advertising. I think a lot of people are saying, look, the digital ad market still isn't where it needs to be, despite the fact that we had seen some positive results from Facebook. The digital ad market for them, obviously still a problem. Same with Google, same with Snap. That was the bigger problem, I think, for for them than the others. But when you look at something like Twitter, we're discussing how it's a private company now, so we don't know exactly how their financials are. But you have to wonder how much people are willing to put into a company that they've already seemingly lost confidence in as Elon Musk took over. And now with this downtime after all of those cuts, will there be more problems ahead as they start to deal with big events like the Super Bowl, and frankly, anything that can happen on any other day that's a big event. Look, we had that earthquake in Turkey. Obviously, Turkey and Twitter had that issue where Twitter was down. Twitter reached back out and seems to have gotten it all handled. That's not a technical problem on their point, but still, when you're looking at major events like that, Twitter is a big place where people tend to go for the latest news. And if it goes down during a significant event along those lines, then it can be really problematic.
Indeed. Well, thank you for that update. Yahoo Finance's Dan Howley, thank you for joining me this morning. All right, coming up, we roll the dice as earnings season hits the casino gaming industry. We'll see who won the jackpot and take a peek into what to expect from the Super Bowl. Stay tuned. Coinbase CEO Brian Armstrong is fighting back against rumors that the SEC is considering removing crypto staking by retail investors, saying he believes it would, quote, be a terrible path for the US, should it be the case. Yahoo Finance's David Hollerith joins us now with the details. David, what are you hearing?
Well, Rochelle, in Armstrong's tweet from yesterday, he made the argument that making clearer regulation for crypto staking boils down to a national security issue, obviously imploring that it needs to be permitted in the U.S. Now, as a primer about crypto staking, it's used as an alternative to crypto mining to essentially validate transactions on the blockchain. So there are a lot of blockchain projects that essentially cannot work without it. Also, from a financial perspective, it involves depositing cryptocurrency into a smart contract in return for some kind of yield. And so questions have come up for several years, actually, about whether this constitutes an investment contract. Now, using Ethereum, the second largest blockchain, as an example, staking works by having essentially anyone can participate as long as they can fork over about $52,000 in Ether by the market rate. And not everybody has that capital. So what has happened in the industry is that crypto firms have offered a service to allow essentially any customers to stake their assets. And what the companies do is they pull together the assets so that they can meet the capital requirements and allow this. And in return, it offers something like a 5.3% annual return. Now, obviously, these companies take a fee from that. And this has been, noticeable to Coinbase's balance sheet. Coinbase, in its last quarter, actually earned a total 10.8% of its total revenue from crypto staking, and about $62 or $63 million. So this is going to be an issue that is going to be continually watched. And it actually came up early in September when Ethereum officially made its move to using staking as its model for validating transactions. SEC Chair Gary Gensler, actually shortly after Ethereum made this move, came out saying that staking could be considered a security. Now, a clear point here is that the service and staking itself are slightly different in terms of whether or not they would be considered a security. And it does seem more likely, based from the lawyers I've spoken with, that staking as a service, which is done by these third parties like Coinbase, is probably more likely to be considered something like that. Now, none of this has actually been brought up yet, but we do expect this to heat up. And when Armstrong tweets about the SEC, there's usually fire to the smoke.
I mean, we know that this is something that would, a lot of retail investors, this is how they get into this space, and that's how they're encouraged to stay in. So it'd be interesting to see what materializes here. We'll be keeping an eye on that story. Dave Hollerer, thanks so much. Well, Wynn and MGM are on the move today on the back of earnings as investors await the big game between the Chiefs and the Eagles, with a record 50.4 million people expected to wager a total of $16 billion on this year's Super Bowl. That's according to the American Gaming Association. Well, for more on what gaming companies should expect, we've got Macquarie Group senior analyst Chad Biden. Thank you for joining me this morning, Chad. So a lot of people wondering, should we still be betting on the gaming industry when you look at these earnings results, especially for Wynn and MGM?
Thanks, Rochelle. Thanks for having me. Jackpots across the board in gaming. You have Las Vegas that's setting all-time records. We heard about that last night from earnings calls, as you mentioned, from Wynn and MGM, who've seen hotel rates up anywhere between 30 and 50% versus pre-pandemic. So clearly the leisure in Las Vegas traveler is very strong. Secondly, you have Macau starting to recover. China was essentially closed for 2 years, more than what we saw in other developed markets, and that's starting to come around. And then more importantly, this weekend, you have sports betting. As we think about where we want to place our bets, so to speak, we still really like sports betting and iGaming. In the fourth quarter, volumes were up about 70% year over year. The big driver of this is population allowability. So last year for the Super Bowl, a little under 50% of the US could legally bet on the big game. This weekend, it'll be about 55 to 57%. So you have new states like Ohio, Maryland, Kansas, and then up north in Ontario, they'll be able to do so. So we still really like the space. You were just talking about technology. That's kind of been a big thing. Huge technology advancements in sports betting, and I think you'll see that in the product this weekend if you're in a market that permits that.
And as we mentioned, some of these new players who have come in now, as we have more states coming online with sports betting, what does that mean, though, for the future growth of an MGM or a Wynn when you do have some of these other players coming in as well?
Sure. I guess, the two drivers are obviously, new states. California was a big one. Many of us were hoping for back in November. They had a state referendum, which was voted down. Some of the biggest states in the United States California, Florida, and Texas, you still can't legally bet on sports betting. So those will be catalysts over the next couple of years. And then the other thing is just, higher engagement and more spending and kind of broadening out the audience. Currently, about 7% of Americans have these apps on their phones, the DraftKings, the Caesars, the MGM, the FanDuel, and the like. And a big goal for these companies is to, promote and induce some of the casual bettors who aren't maybe focusing on every game throughout a night or a week, but maybe, engage with their apps a little less frequently, obviously expanding into the female population. Sports betting historically is over 80% male engagement. So that's a big thing. We expect some pretty heavy marketing during the Super Bowl. World Cup was a nice customer acquisition period, and we expect the same for the Super Bowl this weekend.
And you mentioned the World Cup. They're obviously a global event, but when you look at something like the Super Bowl, what are some of the edge that some of these companies can have when you really do have a very targeted sort of sporting event?
Yeah, the big thing that we've seen since sports betting started in the U.S. A little bit more widespread about 4 years ago versus today is the in-play betting, the different prop bets that you'll see. Historically, you would see some of these for the Super Bowl, but now you're seeing them for every game. So the menu of options is much greater. So if you're an Eagles fan, you can wager that, Jalen Hurts will complete 20 completions and A.J. Brown will have a touchdown. So you can parlay some of these player bets. And then obviously, if you're a Chiefs fan, you could do the same for Mahomes and Kelsey and the like. And these are the things that are really driving engagement. It's actually a higher hold rate for the sports books. So they like people to wager on these types of things versus just the straight up spread for the game. And then also in-game betting. So if the Eagles score on their first drive, you might see that Chiefs line move pretty strongly in the first couple minutes. And if you're a big Chiefs fan, maybe you decide to kind of double down. So there's just more engagement, a bigger menu of options. And we think that'll be something that we're excited to see this weekend. And that'll continue as we get past NFL into NBA, NHL playoffs, and then into baseball, which historically is a low seasonal sports betting season, but you'll be able to bet on each pitch, each outcome of the batter, and that'll, again, improve engagement.
Indeed, because not everyone is into some of these major bets, but some of the more fun, creative sides of betting, you definitely will tend to get more people. It's a more social event that way. Great stuff there. Chad Bynum, Macquarie Group Senior Analyst, thank you for your time. Well, be sure to tune in tomorrow as we continue to talk the finances and betting landscape surrounding the Super Bowl with FanDuel CEO Amy Howe and DraftKings CEO Jason Robbins. You don't want to miss it. All right, coming up, we check in with the hospitality market as Hilton CFO Kevin Jacobs joins the show. Stay with us. Hilton rising alongside post-pandemic travel demand, with investors hoping it can keep that momentum going. The hotel chain out with earnings this morning, with a rise in its occupancy rate cheering investors. Here with a closer look at earnings, Kevin Jacobs, Hilton's CFO, and Yahoo Finance's Brian Sozzi. A big welcome to you both here. I mean, when you compare where we were in 2019, Kevin, I mean, growth across all segments now. What do you attribute this to?
I think we just attribute, well, first of all, thanks for having me on. It's great to be with you guys again. I think, you attribute it to demand, right? I mean, I think there's tons of both pent up demand and just generally demand for travel in the world. And, our products are, we have great products that are in high demand with customers. So as you mentioned, yeah, all three of our primary segments, leisure, business, and group, are now ahead, in the fourth quarter, we're ahead of 2019 from a revenue perspective. And I think what you've seen is, this has been a very leisure-driven recovery, particularly early on in coming out of the pandemic. So leisure travel remains really strong, but now business travel is also ahead of 2019 levels, and group demand, frankly, is, at this point off the charts. Our lead volume so far in January, for leads for potential new corporate meetings and other groups is at all-time highs.
Kevin, let's just stay on January. How did January look from a revenue per available room and occupancy perspective?
Yeah, we didn't, Brian, we haven't given specifically January, but what I would say is the trends that we saw in the fourth quarter have continued, right? We're not seeing any, we talked about on our call earlier, we're not seeing any cracks in bookings. Now, everybody needs to keep in mind our bookings are relatively, or I'll correct myself, very short term in nature. And so if something happens in the broader macro environment, that can turn very quickly. But at the moment, we're seeing continuation of trends into January that we saw during the fourth quarter.
Kevin, I had another CFO on this morning reporting earnings. That's Hugh Johnston over at PepsiCo. He said his base case this year was a mild recession. Are you in that camp too?
Yeah, we are. I think only because we're typically, the way we think about it is we're not economists, right? So we're not in the business of predicting the macro. We tend to forecast and give guidance based on what we think is, consensus view of what's going to happen in the economy. And I think consensus view at this point in the U.S. is for, a slowdown / a mild recession in the back half of the year. And that's the same thing that our current guidance assumes. And that's not to say that, we don't think it could be better or worse. We tend to assume what everybody else assumes or the consensus view of the economy and then go from there.
And one of the themes we've seen this earnings season, a lot of companies trying to be leaner, but you're also in the middle of launching your premium economy brand, Spark. Talk about the timing of that and the sort of market share you're hoping to capture.
Yeah, sure. Well, the good news is we can do both, right? We've been very lean, and we're still running at an expense base that is well below 2019 levels. I think our guide for G&A this year is to be sort of circa, low double digits below 2019, and that's obviously with 4 years of inflation that have happened since then. And then in terms of launching a new brand, yeah, Spark by Hilton is our 19th brand, the 10th brand we've launched, in the last 15 years since the Blackstone leverage buyout and the new management team took over. We're incredibly excited about it. It's what we're calling a premium economy offering. We think that there's a room in, we think there's over 70 million consumers in the US annually who use an economy product, and we think there's room for a very high quality product in that space. It'll be 100% conversions from other brands, and we think it'll be our most disruptive brand to date. So we're incredibly excited about the growth prospects for this new brand.
And something that a lot of has also been mentioned on calls, we look at what's been happening with the strength of the US dollar, some of the currency concerns and how that's been affecting earnings as well. What's your take on that and how you've seen that affect your business in different parts of the world?
Yeah, look, it's definitely been a fuel, a headwind for travel for people from the U.S. going into other parts of the world, particularly in Europe. It's not the only reason our European business has been quite strong, but it certainly helps. And in terms of how it affects earnings, we're a big global business, and we've got puts and takes in currency all over the place. Obviously, we're a U.S. business, so we give, our earnings are based in U.S. dollars, but we have a very small headwind in our numbers this year from foreign exchange. But it can be, in terms of the way it affects demand patterns around the world, that's one of the beauties of having geographic diversification. At times it helps, and at times it can hurt a little bit.
Kevin, do you see China returning to growth within the first half of the year?
Yeah, we do for sure. I mean, I think as China has opened up, you've seen a little bit of a drag in terms of business activity in the fourth quarter because as they've opened up, they've had sort of a spike in COVID cases. And, you know, I think a lot of other people think this too, but we think they'll get through that. And we think you'll see, just like you've seen in other parts of the world, there's going to be a ton of pent up demand for travel. And once people in China can start moving around again, we do think that Asia Pacific and China in particular is going to be a big headwind for our results this year, for sure.
Certainly a lot of companies banking on that. We hope it works out for you as well. Kevin Jacobs, Hilton CFO, and of course, our very own Brian Sozzi. Thank you both for joining me this morning. All right, coming up, we wrap the hour with a look ahead to some earnings after the bell today and do a final check of the markets. Looking ahead to more earnings coming out later today, we're going to be taking a look at PayPal here. As you can see, the payment service, we've been talking about Lyft as well today, seeing how it's going to fare against some of its rivals. We saw Uber doing well as it was able to hone in on most of its businesses, although seeing some weakness in its delivery. Lyft with not as many levers to pull, so we'll be keeping an eye on that. Also, Cloudflare also reporting later on today. And then, of course, looking ahead to Friday, you have Spectrum. We're taking a look at what's been happening with the media landscape. Of course, keeping an eye on what's been happening with advertisers and seeing how that's affecting their business as some of them tighten their purse strings. Also staying with the payment space with Global Payments also reporting tomorrow as well, as we see what this means for consumers and how they're spending. Let's also check out trending tickers that are on the Yahoo Finance website at the moment. As you can see, top of the list there, Disney. A lot of people still focused on Disney after their reporting and the call after the bell yesterday, with that tightening up and the job cuts of 7,000 and more cost-cutting measures ahead for Disney. Also looking at payments company Affirm, down, as you can see there, more than 20% on the day. Also taking a look at Uber, down just about 2%. We'll see how that ends up affecting Lyft. And of course, Tesla off to the races today, up more than 4%. And PepsiCo also, they're up 1 1/3% on the day. As we As we take a look at a final check on markets as we head into this new hour, all three in positive territory. We see that they're well off those session highs, losing some ground there, but still in positive territory. The Dow there up about 60 points on the day. The S&P 500 there up just slightly, about 0.1%. The tech-heavy Nasdaq there down up about 0.1% as well. We're seeing these markets really digesting a lot of this Fed speak, trying to figure out perhaps if they have not priced in enough risk or if they've priced in too much. Obviously, a lot of investors in a very interesting touch and go space here, wondering if this is still the beginning of a bear rally or if they've perhaps built a little too much optimism into the markets for now. We'll be keeping an eye on that for you in our shows. That will do it for now. I'm Rochelle Akufa, but I will be back at 11 a.m. Eastern. I will see you then.